segment reporting is nothing but if the entity ABC and Co. sells 3 different types of products, A, B and C. So then what happens? I will calculate what is the total profit by selling all the 3 products. What is the net profit because of selling all the 3? Apart from that, I want to know what could be the profitability because of selling A alone, B alone, C alone. So I had to prepare the income statement as well as financial position statement, balance sheet for A, B, C separately. This is one segment, this is another segment, this is another segment. I need to know the profit, assets held by every segment, as well as any liabilities related to the segment, total turnover related to the segment, I need to know separately. Apart from that, we prepare the normal consolidated net profit. So usually we will prepare the income statement as well as a balance sheet consolidated format only. But here we want to know separate details for every segment. So A, B, C are being either product or services. 3 different products or 3 different services may be rendered or supplied by A, B, C and Co. And other way, ABC is operating in 3 different locations, Trichy, Kodaikanal and Chennai. We can find out the net profit of all the 3 divisions. Okay, but I want to know what could be the profitability because of running Trichy, Kodaikanal as well as Chennai separately, independently. Is that okay? I need to know the independent profitability also. Clear? Apart from the comprehensive profit identified. And sometimes I may have a combination of these two. Combination of these two means I do business in Trichy, Kodaikanal and Chennai, selling product A, B, C in all the 3 locations. What is the profit because of selling A in Trichy, A in Kodaikanal, A in Chennai, B in Trichy, B in Kodaikanal, B in Chennai, C in Trichy, Kodaikanal, Chennai. And what about the overall revenue in Trichy, Kodaikanal, Chennai? What about the overall revenue by selling A in all the 3 locations? That also be calculated. So it is nothing but normal preparation of the trading and P&L. But if I have 10 different items supplied from my company, do I want to prepare independent financial statement for all the 10? Not necessary, but some mandatory are there, some optional also there. So I am going to consider, I am going to calculate what are the divisions are going to be preparing the segment report separately. Is that clear? That's the logic you have to understand here. Now, if I want to prepare separately for ABC, which is product, this is called business segment. This will be named as business segment. Product wise or service wise. And second part I classified using the locations, then it is called geographical segmentation. So segmentation could be based on the business nature or geographical segment. Now, what is the purpose of preparing this? Better understand the performance of the enterprises and understand the risk and return of the enterprises due to which particular asset. Whether it's related to the A or location Trichy, like make more informed judgment about the enterprise as a whole. That's an advantage. If you're able to find out that B seems to be non-profitable, we are actually losing. Sometimes later we can plan to go for closing that division. So that will really enhances the profit of the rest of the divisions or overall enterprises revenue also be increasing. That's what about the decision we can do because of the segment report. Scope. Consolidated financial statement as a whole. If ABC company and Co. supplies only one item A in Trichy, do I want to prepare that segmentation? No, we don't have any segment reporting required for that because only one location, only one product. Multiple products, multiple location, then automatically comes. Now, you have to understand what is called enterprise revenue. So, the total will be called enterprise revenue. Okay, total will be called enterprise revenue. Okay. So, you don't need to understand this one. It's very simple, normal P&L account only. Normal P&L account only. The main point to be studied in this case being this part. This part. Once you are master with this topic is over. Clear? What are they? How can you identify the reportable segments? Reportable segments. XYZ and Co has 5 segments: A, B, C, D and E, and they prepare income statement as well as financial position statement, balance sheet in total that's needed. Now the question is, do I want to prepare for A separately, B separately, C separately, D separately, E separately or not? If you are interested to prepare the financial position and the income statement separately for A to E, no problem. There is no any harm. There is no any harm. Is that clear? You can prepare independently for A, B, C or D. But it's really tough, sir. Then what can we do? As per Ind AS number 17, minimum you need to prepare some segments identified for the segment reporting purpose. And based on what that minimum. Okay. So, 3 criteria are there. One is segment revenue, another one is segment result, another one is segment asset. Okay, revenue. You know that revenue is nothing but the revenue from that particular segment. What is the total revenue? Sales by selling goods from goods of A, goods of B. That's what about segment revenue. Segment results is nothing but profit or loss. Segment asset, what is the asset held by each and every segment? Out of the total value, total assets, okay, in that more than 10% revenues due to one of the product means that is a reportable segment. At least 10 or more than 10%. The revenue from A, probably total revenue 100, A generates 15 rupees, then A is a reportable segment. E generates only 5 rupees, non-reportable segment. Non-reportable segment. This is reportable segment. You understand? Out of the total revenue, if the revenue of every segment is either 10% or more than that 10%, then automatically that will be a reportable segment. Point number 1. Quantitative threshold. And the next one being, A can sell the goods to B, or if we have the two divisions, location based. Trichy, Chennai, Kodaikanal. There is a sales from Trichy to Chennai location as well as outside location. To Chennai it is 10 rupees, to outsiders it may be 100 rupees. Forget about the revenue. Find out the external revenue of all the 3 divisions with the external revenue of reported segment. For example, here A is a reportable, E is not reportable. Assume that B is also reportable, C is also reportable. These 2 are not reportable. Once you find out the reportable segment based on the criteria 1. What is the criteria 1? Revenue, result and asset. Based on that, we decided these are the reportable segments. Once we decided that these are the reportable segment, the next duty is what? Find out the external sales of these 3. The external sales of these 3 being 15. And here 30, here around 10. The summation of the external revenue of these 3 divisions being 55. In the total external revenue, the reportable segment's external revenue should be at least 75. At least 75. That's the second condition. If it is not at least 75, no other way, you have to add some other non-reportable segment also your reportable segment. Though it is not required, but the external sales is less than 75% from the reportable segment means you are not properly responding or reporting. So you have to now make some other non-reportable segment also reportable segment. 2 conditions. Sir, can I show all the divisions as reportable segment? That's your option, well and good. Minimum requirement as per AS number 17 is discussed here. Based on revenue, based on result, based on asset, 10% and more, if that particular division is having or segment is having, then you have to prepare income statement as well as financial statement separately. But after completing that, the reportable segments, the external sales is group it and totally enterprises external sales totally. If the reportable enterprise segments total revenue is more than 75% or 75%, no problem, finish it off. Yes, you need to add some other reportable segments so that all the reportable segments, the total external sales should be more than 75%. Second condition. Condition 1. Condition 2. Sir, management prefers to show a small segment as a reportable segment. Sir, it's not required, sir. Very insignificant matter. But management prefers. Can I do so? Yes. Optionally, you can show all the things also, but mandatorily these two. Note. Once a segment is reportable due to the quantitative threshold, should continue to be the reportable segment in the succeeding years also. In the next year, the revenue decreases to only 6. Only 6. Out of 100, 6 means less than 10%. But previous year, A being the reportable segment now, hereafter A is reportable segment only. And even though the segment is not meeting the threshold limit. Clear? So these are the point 1 and 2 you have to understand. Now let's start with question number 1. Come on. Tell me. The chief accountant of Sports Limited, gives the following data regarding its 6 segments. How many segments are there? 6 segments. Segment assets, segment results, segment revenue, and the total is also there. In case of segment assets, 200 means 10% or more, 20 or more. 20 or more means M has 20 or more, N has 20 or more, O has 20 or more, P has 20 or more, Q has 20 or more, and R is not reportable. Due to the segment assets, we found out that 5 segments are reportable. For these 5 segments, you have to find out the profit and loss independently. Right. Segment revenue 1200. In that 10% 120. This segment revenue includes internal and external both. Outside as well as within the segment also be taken. But for the consolidated 75% calculation, no, external sales only will be taken. For this, the revenue being, so for example, in this case, the revenue for T, in this case being 10 plus 100, 110. For the 75% calculation, only we have to take external revenue. Is that clear? Hope you will be now able to understand. For the first case, segment revenue means the revenue due to selling goods outside as well as transferred into the other segment. Okay. Now, 1200, so 120 and above. M is a reportable segment, N is a reportable segment, O, P, Q, R are not reportable segment. But in case of result based, we have profit and loss. Then how can we calculate? Very simple. First one is summation of the profits. Next one is summation of the losses. Between these two, whichever is higher will be taken, in that 10% will be the limit. What is the loss? Profit 50, 10, 10, 30. 100 rupees is the summation of profit. What about the loss? 110, 190 plus 10, 200. Between these two, which is the higher one? This one. In that the 10%, absolute term, 20. It is not 20 profit or 20 loss. It's absolute term. Without seeing the sign, you have to consider the value. So 20. M is a reportable segment. N, it is also more than 20. Sir, minus 120 means lesser than. No, it's not lesser. You have to consider only based on the absolute term. So without seeing the sign, 190 will also be taken. Not a reportable, not a reportable, not a reportable, reportable. Now find out the reportable segments. M is a reportable segment, N is a reportable segment, O is also a reportable segment, P is also reportable, Q and R, all are reportable segment. M is reportable due to the three criteria. N is also reportable due to the three criteria. But OPQ are reportable due to assets criteria, and R is reportable due to results criteria. Is that clear? Very simple illustration. Very often you can expect such a sum carrying 4 marks and 5 marks, like in case of segment reporting. So leaving the property, plant, equipment and that cash flow statement that we have already completed. Leaving the property, plant, equipment, all the accounting standard requires us to 1 hour to finish. Very simple. Very simple. Shall I go for the next one? So question number 1 is over. All are reportable segment. Now question number 2. Yes. Now segment result, segment asset 200, no. Okay. Now what is the question? General manager F&A is of opinion that segments M and N alone should be reported. Is he justified in his view? Let's check. As per the segment assets, total assets of the enterprises being 200 means 10% on that being 20. 20 and above, if any segment has, then that will be reportable. So M reportable, N reportable, O also reportable, P and O, Q are not reportable segment. In case of result, you find out the summation of all the profits only, find the summation of all the losses only. 30, 50, 15 and 500 and loss 20. Between these two, whichever is higher, in that 10% should be your profit or loss in absolute sense, means 10 rupees. So this is reportable because the value is more than 10. This is reportable more than 10. This is reportable more than 10. This is reportable more than 10. This is not reportable. This is not reportable. Is that clear? And based on the revenue, 10% and more, you have to take the total revenue. External, internal, both together. What is that? 800. So segment revenue, we have external and internal. Internal means segment to segment. But for the revenue based segment determination, for that you have to take the total revenue, which is this one. Total being 800, in that 10% 80. 80 and above will be reportable. So M is a reportable, N is also reportable, O is a reportable, and P and Q are not reportable. So what are the reportable segments? Now we have M, N, O, P are being the reportable segment. Apart from that, you have to go for the cross checking. One more checking. What is that? 75% from the external revenue. In that, 75% should be for the reportable segment alone. What are the reportable segments we have? These are the 4 reportable segments we have. 75% means 375. But if you total this, 460. So this condition is satisfied. This condition is satisfied. The reportable segments external sales only, if you sum that, that will be more than or equal to 75% of the total external sales. Then okay. If it is not so, then you have to again go for some more adjustments. Is that okay? Now, general manager states that only M and N are required. No, his statement is not acceptable, not allowed. Clear? Shall I move on to the next one? Third question. Now, Third question, you have to prepare separately. We have been given a consolidated income statement. Following details are given for Fimpex Limited for the year ended 31st 2010. Sales. Sales is given for 4 different segments. 6,782 will be the total sales. Similarly, expenses also given for all the 4 segments separately. And we have been given some common items and identifiable assets for each and every segments. 10,355 is the total assets. In that, identifiable for the 4 being 7,320 and all. Apart from that, a common asset also exists. General corporate assets 722. Other information, we have been given intersegmental sales for the other departments, other segments. Okay. Operating profit includes 33 lakhs on intersegment sales. We'll see that later on. Information about intersegment expenses are not available. We have not been given intersegment expenses. Though it is not given, no problem. Sales minus your profit. Profit detail is there. So if you subtract, then you will be able to find out the total profit for total enterprises purpose. But later you can apportion easily. You are required to prepare a statement showing financial information about NDA Limited operation in different industry segments. So you have to calculate for the different industry separately. Food products, plastic and packaging, health and scientific. So how can you prepare? Revenue minus expenses, you will be getting the operating profit. That's all. Vertical form. Income statement prepared under vertical form. Okay. Now, let's see. We'll start with sales. Maybe this is external sales. Then we have been given intersegment sales also. Intersegment sales. How can you prepare? Come on. You have to prepare separately like branch account. You have to prepare for food products, plastic and packaging, health and scientific, others, and total. Consolidation. Okay. Revenue. Under that, we have been given external and internal. External being this one. Probably this is total revenue. In that segment revenue is this one. Then you will get the total revenue here. Total revenue being 5,650. Revenue for any segment given, it is assumed to be total revenue only. 625, 345, 162, consolidation 6,782. Intersegment sales list being given here 55, 72, 21, 7. Okay. This is going to be eliminated while consolidating. While consolidating, this will be eliminated. What is the total of this? 155 should be eliminated. So if you eliminate, this is the total of intersegmental. While consolidating, this is intersegment. While consolidating, you will get the balance. From 6,782, you consolidate After subtracting this one, what is the ultimate value? 6,647. Okay. 27. Okay. 27. Now, external sales could be the balancing one: 5,595, 553, 323, 155. Then total value being 6,627. This is the external. Huh? 324. Okay. 324. Okay. So we got the revenue. Now what I have to do? I have to subtract the expenses for every segment. So this is the segment expenses. Segment expenses. Let's subtract that expenses for segment. 3,335, 425, 222, 200. Okay. Wait, you don't get the total now. The total I will write here 4,182. I have to do some adjustment. If I subtract the expenses, what will I get? Operating profit. Sales minus expenses. 2315, 200, 123, 123, and here 38 negative. 38 negative. Is that okay? What about the total profit? $2,600. Okay. 2,600. These are the total, but I have to segregate this to what? Internal transfer as well as external transfer separately. Internal and external, like you have to find out. But here the problem is you're not aware about expenses for internal. This one is also question mark. This one is question mark. Okay. If you add up these two, you'll get this one, 4,182. And this one, if you add up these two, you'll get this value. You are not aware about this one, but if you add up these two, this will be 4,180. If you add up these two, this will be 2,600. Clear? But the last I told you, no. Operating profit includes 33 lakhs and inter-segment sales. So this 2,600 includes 33 for inter-segment sale. Then 2,600 minus 33, 2,567 is the enterprise income. And 155 is the revenue, 33 being the profit, means what could be the expenses due to the internal transfer. You can find out the balancing figure now. 122, and balancing expenses is for the for the entire company enterprises as a whole. This value being 4,060. 4,060. If the information is given, the sum is very simple, but they have made slight complication by doing this. The data is not available. Expenses for inter-segment, operating profit for inter-segment you have to give. But operating expenses, profit for the inter-segment is given, expenses not given. So we calculate as a missing data to arrive that value. That's clear. Next. So sales over, expenses over, We have been given the other item. Other item are the common expenses, not related to any of the segments. You cannot segregate for any of the segments here. What can we do now? Very simple. From the common, you can subtract this. From the common, data of the common, no, there you can subtract. Yes. General corporate expenses. Corporate expenses, common one, not for any segment, the value being 562. Income from investment is the income received from other sources, right? So, income from investment, investment income, the value being 132. This one is a profit, this is expenses, this is income should be addable. That's how you can note it. Now find out the value now. The value what? Because you have not subtracted the interest, you will get the earnings before interest like if you want. Or you can subtract the interest component also directly. Interest component being 65. Minus item. After subtracting 65, 2072 is nothing but income from operations, continuing operations, net income. Don't stop with that. Whatever the data you are able to segregate for each and every segment, you have to show it. So we have calculated and shown segment revenue, segment profit. But we need to find out segment assets also to be reported here. Now, segment asset. Clear. Now, we have been given identifiable assets and general corporate assets. So, identifiable assets and general corporate assets. Yes. Segment assets. Segment assets, general assets. Segment assets being 7,320, 1,320, 1,050, 665, then overall value being 10,355. Apart from that, we have a common asset 722 only for the consolidation. You may show this. So the value being 11,077. Is that clear? That's how you can prepare the reportable segment here. Mrs. XYZ Limited has three segments, namely X, Y and Z. The total assets of the company amount to 10 crores. Segment X has 2 crores. Segment Y has 3 crores. Segment Z has 5 crores. Segment assets also given. Deferred tax asset included in the assets of each segment, DTA. Okay. The accountant contends that all the three segments are reportable segment. C, 3, 2, 3 and 5. But it includes what? DTA, 0.5, 0.4 and 0.3. And accountant contends that all the three segments are reportable. But in case of DTA, deferred tax asset, I will discuss that along with the DTA chapter. Okay, not here. DTA seems to be an asset like, but it should not be included here. So if you exclude, what about the value? 1.5, 2.6 and 4.7. Then what is the total value? 9. 9 crores. If you sum, then it is 9 crore. 9 crore means at least 10% should be there for reportable. Okay. So 90 lakhs. All the three segments are having the assets more than 90%. It means 10%, 90 lakhs. So all the three are reportable only. Two questions are asked here. Question 1 is all about whether DTA is included or not. Yes, not included. Second question, is it all are reportable? Yes, all are reportable. Even after removing, we still confirm that it's reportable only. Clear? Next. An enterprise which has neither more than one business segment nor more than one geographical segment. They have only one business. Is required to disclose segment information? No, not required. But if you want, then you can give a note, sir. We are not required to disclose. We are not required to prepare segment report. That's all. It is not applicable. That's how you can give the note, but of course not required. Of course not required. Disclosure in note is enough. Note is enough. A company has an inter-segment transfer pricing policy of charging cost less 10%. The market price are generally 25% above cost. Is the policy adopted by the company correct? See, in the case of segment reporting, what are reportable, what are not reportable, only we are going to discuss. What the policy they follow continuously will not be bothering. That's not a botheration. Whatever the company's policy, okay, they follow regularly is accepted. A regular method will be accepted. That's all. If it is regular, no question. Microtech Limited produces batteries for scooters, car, trucks, and specialized batteries for inverters and UPS. How many segments should it have and why? So here, how many segments we have? How many segments? The Microtech produces batteries for what? Scooter, cars, trucks. Probably all the three will be named as what? Transport vehicles can be grouped into one. But inverter for UPS is not coming under this part. Inverter and UPS. Hope these two will be considered as second variety. Hope will be now able to understand. So how many segments we have? 2 segments. Okay, batteries for scooters, car, trucks are all for the transport vehicles only. Inverter and UPS, it's totally different. This model is different, that model is different. So you need to have 2 segments. Based on the risk and return. Based on the risk return. Now, let me complete some theory. Okay. Now, see. Treatment of interest for determining segment expenses. Usually, interest is not includable, that is separately calculated. That's how we calculated the sum. But includable in segment expenses in the following case when the operation of the segments are predominantly financial nature. If it is being the banking company, then it's includable. For the banking company, interest is the operation expenses. But interest is included if the interest is calculated as per AS number 2 or AS number 16. Borrowing cost. Under borrowing cost, when the interest is going to be capitalized or added to the product or added to the inventory is going to be discussed. You studied in your taxation, right? Okay, any borrowings for that, if you are paying the interest up to the date of put to use of the assets will be capitalized. After that, it can be debited to the P&L account. Same happens here also. If it is related to any stock or any assets to be capitalized, then it should be capitalized, which is going to be guided under AS number 16. No need to worry about that. No, sir, this is only general expenses, debit to P&L account commonly. It cannot be for any expenses, any segments. Now, we'll go for the reportable segment. Reportable segments. What are the reportable segments we have? Already I told you. Okay, what are they? Here, I started with this one. One is product based, another one is location based, another one is product and location based. Apart from that, ABC has the business only in Trichy, supplies A type of product. I have only operations in Trichy, supplying only one type. Usually segmentation not applicable, provided I get the customers from Three different locations. Customers are from Trichy, down south, and north. So usually, if you take Singer Academy, we get the customers from Trichy and down south, not from the north. Very simple. Now I can easily guess. So if I am able to guess, then if I am getting the students from the down south, then how can I fix the fees? Okay, if I am getting students from the north side, probably from Mumbai, for them the cost of living it is very high, and they want to have the sophistication. So if I want to give the training to the students from Mumbai coming here, then I have to build the structure as per their requirement. That infrastructure and price may be higher. Depending upon my customers also, it requires some influences. So then, first one is all about product based. This is location of what? Location of service provider or supplier's asset. I have the asset, means my branch in Trichy, Kodaikanal. If you go on, there is a room and hall and all facilities. This is also location based, but location of the customer will be the matter. Location of the customer. These two are called geographical based. Sir, do I want to segment myself product wise? Yes. Sir, what about the place wise? This one. Do I want to show this one and this one, sir? Yes. Okay. Which is primary, sir? Sir, my primary thing is only this one, sir. What about this one? If it is available, then I may be better use it for my decision making, sir. Then this will be called as primary segment. This will be called as secondary segment. In case of primary segment, you will give all the details. In case of secondary segment, try to give all the details. All the revenue, expenses for your segment, assets and all. But if it is a secondary, at least some basic information, if it is available, okay. Otherwise, if you are able to give full, okay. Deciding what are called primary, what are called secondary segmentation. The entities or enterprises risk and return affected predominantly by product and service. Then primary segment being business. Then even you can give the customer also. For Sahasri Singar Academy, so primary being, I need to know what is the collection from CA as well as CMA separately. That's a primary. I am operating only in Trichy, so I don't have multiple branches. Then what happens then? I get the customer from different locations. The customers from Trichy, customers from down south, customers from north. If I am able to identify this detail, and I can make the decision accordingly. This is secondary. For the primary, I have to give full details. What is the total fees collection? What is the expenses for every division? But in case of secondary, no need. At least basic information is number one. And suppose difference in product and services and difference in area both involves. I operate for CA as well as CMA. Okay. As well as different area. I operate in Trichy as well as Chennai and Kodaikanal. Then geographical secondary. Geographical, especially rather than customer, you can take the asset location also. So if product as well as area both are important, primary segmentation being business, secondary being either asset or customer. Different area, you have the location of assets as well as customers both. You have the location of assets and customers both. And primary being geographic, then business is important. Business, customer secondary. But asset only important, sir. Then asset is the primary and customer geography and business may be secondary. No, sir, my customers are primary, sir. Customer based details will be the primary segment. And business based details and geography related to the asset detail may be secondary. So whenever you identify this being the primary, full pakka details should be there. In case of secondary, try to give the pakka details, else whatever the details available you can provide. Is that clear? Now, related to the policy. Whatever the policy the company follows, enterprise follows, that may be followed. There is no any guidelines related to the usage of policy in Segment A is number 17. Segment policies. Uniform accounting policies for the enterprises of whole should be there. That's all. Except for reporting internally to the board for the decision making purpose, they can use it, but for not for A is number 17 is required. And the basis of measurement of this additional information is clearly described. If it is clearly described, okay, it is only for the decision making purpose you can show. Otherwise, whatever the policy you follow regularly, we can stay with that. So that's how we have seen one illustration, right? Now, in case your segment being the primary means give the revenue, result, asset, liabilities, cost incurred for acquiring the assets and life, depreciation, total amount of significant cash, non-cash expenses other than depreciation, any other information. You have to you have to give all these details. Okay. In case of secondary, sir, not so much. If the primary being business segment, then secondary should be what? Customer or asset, whatever it may be, depending upon the nature. Okay, that can also be shown. If the primary segment is a geographical segment, then location of asset and location of customer, that's a primary. Then what could be the secondary? Business will be the secondary. If the primary being the business segment, customer based location, asset based location being secondary. If the primary being a geographical segment, either it may be location based, asset based location or customer based location, then business segment being the secondary. Then you have to find out what is the revenue for each and every, that you can report whatever things listed here. Okay. Now, presentation of reconciliation. What the statement we prepared the last for 4 segments and total consolidation. How the value is now totaled and how much is for internal segment. This calculation. This is only a reconciliation. The revenue for all the 4 plus inter-segment transaction, and you will get the consolidation. Segment revenue should be reconciled to enterprise revenue. So A, B, C, 3 segment. Find out the revenue for each and every segment, and then A, B, C total revenue also. Not only revenue, result, assets and liabilities. All these things should be independently calculated for every segment, and how this is going to be totaled and calculated for the enterprises revenue. Is that clear? Hope you will be now able to understand this part. Any doubts? Now, so we have lots of advantages for by preparing the segmentation. So you will understand which segment is really favoring me, which is not so and all. Then, is there any drawbacks, sir? Yes, still you have some drawbacks. Objections and arguments against segment reporting. Sir, it is not advisable, sir. Don't prepare segment reporting. Why? A, B, C. If you prepare, A gives you 100 rupees profit, B gives you 5 rupees loss, C gives 50 rupees profit. What happens if you present this way? Management tempts to stop this one, right? Is that okay? But if you are going to the shop for purchasing any garments, and the bill being 1000 rupees, and you will get a cover, because cover now you have to pay additionally. Give me 5 rupees, sir. Actually, they purchase the cover for 10, but they charge 5 rupees, means they are actually losing 5 rupees. After purchasing, if you ask, the business owner says, sir, 5 rupees loss, sir, because of cover issues, sir. We compel the customers to bring their own cover. Suddenly, if you go, purchased, while billing, where is the cover? Sir, I don't have the cover. So, then if you don't have the cover, you will just pick in your answer. I'll tell you what. Keep it with you. I'll come in the next time. That's all. I will not go to the shop next. If the management makes a decision that this is not profitable, if they want to stop unwantedly, it affects the other business also. Then there's an objections of preparing segment reporting. Segmental revenue and expenses are not distinguishable. Sometimes it is not distinguishable. Segment results depend on their interdepartmental transfer pricing also. From here, the transfer, no, that will also have some impact. It's not fixed logically. It may be not logically fixed. Some common resources which is not divisible segment wise. Rent. Rent paid for all the three products put together 1 lakh rupees. How can you say that this 1 lakh is only for A? Okay. And marginal costing, you might have studied, the same logic happens here. This is for all the three divisions put together. Since no proper allocation of cost is available, we cannot allocate the cost for each and every product. Usually the segment result is also not meaningful. Small company may disclose trade secret, but may not require for the big company. Big company, how will they disclose their profitability? Reliance, they are doing lots of business under Reliance banner. From petroleum products to petrol to geo system. Even now, they introduced the finance also. If you ask them, what is a profitable segment in your entire divisions? Is it geo mobile or petrol, or is it probably retail showroom? How will I say? That's a problem. Big company, that's a trade secret. They don't want to disclose. Geo launched their telecom services at free of cost for more than 1.5 years. Thereafter, slight tariff fixed. That's how they captured the market without even single advertisement. Earlier to that, Airtel had lots of advertisements. If you could remember some years ago before Jio, wherever you go, there may be Airtel advertisement. Our entire payment for telecommunication bill goes for the advertisement only in Airtel. And this fellow Jio launched their product without even single advertisement. In the roadside, no, I saw a crowd. Usually, if there is a crowd, I don't want to go there because more or less there will be, most of the cases, there may be forgery. A crowd. Mobile phone at free, means telecom service at free. By the time, I purchased 1 GB by paying 251 rupees. 251 rupees from Airtel. And 0 for unlimited data. How do you believe that? I don't stop and some other cheating fellow is now here. That's how it will go. Sometimes later, one of my close friends comes to my office, sir, I purchased that Jio, sir. Then only introduced Jio. Superb, sir. The network is also great, sir. Is it so? It seems to be forgery. Sir, it's free only, no. When they demand and it seems to be forgery, we'll throw that SIM out. Oh, the logic is good. Okay, we'll try. That's how it started purchased. 250 rupees, suddenly it's 0. I asked him, how many GBs you are using a day? Sir, yesterday I used 4 GB, sir. 4 GB? 250 for me, 4 GB, 1000. It's only once, no, in the entire month. Oh my God, give me. That's how the Jio got picked. Now also Jio is offering around 3000 rupees per day, 2 to 2.5 GB, like for 365 days. Almost 700 and some 700, 900 GB they are offering just for 3000 rupees. Still, the price I paid by the time, no, not reached. 250 per GB. Still, 1000 GB for 3000, 3 rupees only. In my days, I paid 250 rupees per GB. They won't now disclose. Initial period, there is a huge loss. If they would want to disclose what is the profit in Jio, there is a loss only. They reach the break-even point in the second year or third year only. They don't want to disclose what is the trade secrets there. So that's a problem to show that segment reports. Okay. So with that, this accounting standard 17 segment reporting is over. See, if the transactions between two parties, A and B, transactions between A and B, okay, if there is any transaction between A and B, check whether these two parties are related party or not. These two parties are related party. Related party. Okay. So number one being transaction between two parties Number 2 being, if these parties are being the related party, now it's your duty to disclose. What to disclose? What to disclose? Nature of a related party. Nature of related party. Nature of transaction. Value of transaction. Preferably arm's length price. If I am selling the goods to my brother, I may sell at free or meager money in order to help my brother. It is your relative. You can help your brothers. Because of helping, you are now violating to show the real profit. If you are not showing the real profit, you are paying lower tax to the government. See, the moment I cross the limit, I have to pay the tax. If my brother is jobless, what happens then? I purchase a commodity for rupees 1 lakh, transfer to my brother for 1,05,000 rupees, and from my brother's name, I sell it for 1,50,000. Showing that 45,000 is my brother's profit, my profit is only 5,000 rupees. My brother has not reached what? That basic exemption limit. So he is also not paying the tax. It's a cheating only, no? In order to avoid that, AS number 18 is there. AS number 18 says, if it is being the transaction between the related parties, a transaction nature as well as the related party nature, transaction value, and whether it's a real value or not. You have to disclose that what is the current value in the market. The current value in the market, the value between the known parties. Known parties. If there is a relationship. If there is no relationship, these parties are known, then the value be only normal value, which is called arm's length price. Because of my friend, relative, the price is getting influenced, I may fix differently, that will not be considered as correct value. So, sir, I'm selling at the correct value only, sir, to my brother. The value is 1,50,000. I'm selling this one to my brother for 1,50,000 only now, sir. I have not cheated. No. Whether you cheat or not doesn't matter. If it is being the related party transaction, you have to disclose with the value and state the arm's length price also. We'll decide later on. Okay. Related party relationship. Only how many steps you have to understand? Only 3 steps. Now you have to understand what are the transactions are there. What are the transactions are there? Buying the goods from the party, selling the goods to the related party, and rendering service to the party, receiving the service from the party, lending or borrowing from him, and giving the guarantee for his loan or getting the guarantee from all these things are called transactions. Okay. Now, what sort of relation will be there? Right. To decide who the relationship, some features are there, related party relationship. At the time during the reporting period, when do you want to show this? Reporting periods. If you are reporting on 31st March for this period 2026 or quarterly once, you have to do this. One party has the ability to control the other party. A can control the other. Okay. Relationship is due to what? Control. What A says, B silently obeys. Control. But what A says, that will also influences the decision of B, then it is called significant influence. Significant influence. Okay. Significant influence. Clear? So, one party has the ability to control or exercise significant influence over the other party related to what? Making financial and operating decision of the entity. Then we can decide that these are called related party relationship exist. Now, related party transactions. And what are the transactions? Buying and selling of goods, buying and selling of assets, lending and borrowing, guaranteeing collaterals for the loan, leasing, hiring or licensing, transfer of RD, these are the transactions. What is called relationship? If these characters are there, then relation is there. And what sort of relationship could be defined here? Okay, let's see. Let's see. I have given 5 cases here for the relationship. Okay, these are the 5 cases we have. These are the 5 cases we have. Enterprises, associates, individuals owing, KMP, okay, and persons in 3 and 4. Persons in 3 and 4. These are called a related party. Exceptions. You understand, these 3 are not considered as a relation. For an example, so already we define what nature should be there for deciding related party. Now, who are the parties are falling into this? Holding company, subsidiary company relationship, fellow subsidiary. Okay, A company controls B company with holding 50% share. A company controls C company with 50% plus share. In this case, for B and C, A being the holding company, for B and C, A being the holding company, for A, B and C being the subsidiary company. Subsidiary company. And what about the relationship between B and C, sir? They are called fellow subsidiaries. Fellow subsidiaries. And now, A, B, A, C, B, C, all are called related party. If there is any transaction between B and C, that should be disclosed properly below the financial reports. The relationship could be, control could be direct, indirect or common control. A controls B, B controls C. So, A is a holding company, B being the subsidiary company, C is a subsidiary of B. So, from this it is very clear A controls B and B controls C, otherwise A controls C indirectly. This will be called as related party. Shall I move to the next one? Next part where A holds share in D anywhere in the range between 20% to 50%. If it is more than 50, holding company status there. If it is anywhere between 20 to 50, okay, or A controls X, B also controls X, where A holds 50%, 30% share, B holds 30% share, and n number of other retail investors holds 40% share. If there is any AGM, no, retail investors will not come. If I have only one share, AGM is organized in Delhi, will I go for that? Only one share purchase for 100 rupees, I don't go. N number of retail investors holding 5 shares and 10 shares, like, they will not go. They will not go. Is that clear? In this case, you have to understand, A and B both will tie up themselves to control whatever the decision of X. Then it is called joint control. Okay, somehow, joint venture. If the holding being anywhere between 20 to 50, then it is called holding company. It is associated company. Also be considered as related party. Holding more than 50 is called what? Holding and subsidiary, fellow subsidiary. Holding anywhere between 20 and 50, I call them being associate company. Either it is holding anywhere between 20 and 50, or I myself are having tie up with somebody else to control, then also be associate company. Associate companies. Then, in case of, sir, what happens, sir? Individual business owner. Okay, individual owning, directly, indirectly controlling others by voting powers. For example, Mr. A, ABC Limited Company, ABC Limited Company, where Mr. A holds more than 50% shares in ABC Limited, more than 50% shares in ABC Limited. Individually, then these two parties are relatives. Not only that, Mr. A's relatives, spouse, brother, sister, son, if there is any transaction happening between these two, also be called as related party transaction, because in case if the share held by individual, not only such individual's relative will also be controlling this, then they are also be related party. Okay. Individuals voting directly, indirectly by voting power, control or significant influence. That control means 50% plus significant influence means anywhere between 20 to 50%. Not only that individual, relatives of such individual will also be considered as related party. In case Mr. X, who is being the MD of this limited company, because of the posting he can control, no, then also related party, MD, key management personnel and their relatives also, MD, whole-time director, manager, but not necessary for the non-executive director. In case he is being the non-executive director, don't worry about that. So, MD, whole-time director, manager are the key management personnel, and any transaction between the company and those MDs, MD and whole-time director, no, that is also be reported. Because it's a related party transaction. And persons and 3 and 4, these two, okay, may consider being the significant influence over the other enterprises. Okay. It's not direct control. So, who are they? The relatives and key management personnel, they are having the significant influence. They don't have the shares, but may be considered a significant influence. Exceptions are there. Okay. Common director. A being the director for XYZ Limited and director for IJK Limited. A being the director for XYZ as well as IJK. For these two entities, A being the director. Now the question is whether these two are fellow subsidiaries or is there any related party? No. And that too, this A cannot influence these two. Common director not able to influence the mutual dealings. The transaction between these two, for this A cannot influence, then these two are called not a related party. If I have only one customer, sir, I don't have any other customer, then supplier and customers are related party? No. It's not a fact that you have only one customer, because of that reason is being the related party. Similarly, if you have only one customer, you don't have many suppliers, you have only one supplier, one franchisor. In that case, can I say being the control? No, there is no any control. These are the exceptions. Okay. Supplier, franchisor, distributor, general agent. Okay. With whom transacts a significant volume. Significant volume, still it's not considered as control. But in case of finance providers, trade unions, public utilities, government departments, government sponsored bodies also be influencing, right? Union demands for the pay hike for their employees. Immediately don't say, sir, this union is controlling, so there is a relation. No, not required. So these entities. Government will come and inspect whether are you maintaining all the things in prompt manner or not, or they will take the actions on you. Then government body and that entity is considered as related party. No, not required. Hope you'll be now able to understand or call related party. Exception case also we have considered. Now, relative. In case of individual, who are called relative. If I am talking about director Mr. X, okay, he is being the MD, XYZ Limited. Okay. So definitely Mr. X is the related party, not only X, his spouse and son, daughter, brothers, sisters and father and mother, all will fall under family. So the individual, not only that, spouse, son, daughter, brother, sister, father and mother who can influence or influenced by the individual, such individual also be considered as relative. Now, cases where no disclosure is required. Confidentiality required in terms of statute or by any regulator or competent authority, then you no need to disclose. Sir, it is trade secret, sir, we cannot disclose, though it is a transaction between the related party and related parties. No problem, you will be exempted. And consolidated financial statement in respect of intra-group transactions. For example, H, S, holding and subsidiary. These two are related party, but you are preparing a consolidated financial statement. All these things are going to be merged there, so it is disclosed automatically. Then you no need to separately disclose. Transaction of one state controlled enterprises with other state controlled enterprises. Okay, Tamil Nadu government controls one enterprises 1 and enterprises number 2. Can I say these two being the related party? No, not required, because it's a state government. Okay, clear. In these cases, you no need to disclose this related party transactions with value. Now, classification of related party. Already told what is called control, what is called significant influence. Already told you. If it is more than 51%, then control. If it is anywhere between 20 to 50 with some voting, and where I have the power to represent in board of directors or material intercompany transaction, I can influence. Participation in policy making. For the technical information, you have to depend on me, or interchange of managerial personnel. My company directors will come to your company also to administrate sometimes, but not necessarily completely controlling them, significant influence. But 51% shareholding in case of board of directors, ABC company's board of directors as well as XYZ. XYZ company's board of directors being almost 7 numbers, where ABC has the power to appoint 4. Then also, by composition of board of directors, they are able to control, then control is there. And substantial voting power by statute, by any agreement also, you can have the voting power more than 51%, then also you have the control. So you have to understand the difference between control and significant influences. Now what to disclose? Already told whether is it being the due to control or due to significant influences. In case of control, due to control, then automatically you have to state the related party's name and nature of relationship. Due to significant influence, there is no transaction. Significant influence, but transaction is not there, then no need to disclose. Due to both, control is also there, significant influence also there, transaction also there, then what you have to do? Nature of the related party, name of the related party, relationship, transaction nature, volume, and any other element essential for understanding financial statement, and any other outstanding return back item, everything will be disclosed. Disclosure is mandatory even if the related party transactions are at arm's length price. Already told even the prices are genuine, there is no any cheating. Still, of course, the transaction being between the related party, you have to disclose properly. Clear? Hope now you'll be able to understand here. I started with this one. Okay. 3 points. Number 1 being transaction. Number 2 being explain the related party. Number 3 being disclosure requirement. In related party, we have 2 natures, control and significant. And I guided you what is called transaction. Even though if the transaction are at arm's length price, still you have to disclose. So these are the points you have to remember in this chapter. So with that chapter is over, we'll see some practical illustrations in this chapter, right? Clear? Yes. Okay. Narmada Limited sold goods for 90 lakhs to Ganga Limited. Okay. Goods. During the financial year 31/3/2022, the managing director of Narmada Limited owned 100% of Ganga Limited. Okay. MD. He is being the MD. Okay. X. Probably will let him name X. X being the MD here. And X holds 100% share here. Okay. The sales were made to Ganga Limited at normal selling price followed by Narmada Limited. This is at what rate? Arm's length price, normal sale price. The chief accountant of Narmada Limited contends that these sales need not require a different treatment from the other sales made by the company. You no need to show it separately from the other sales. You can club with the other sales also. That's how the question is there. Okay. Now, is the chief accountant correct? He is being the MD, related party, and here holding more than 100% and control is there. These two entities are controlled by a common person. Then the transaction between these two is the transaction between the related party. Though the transaction between the related party transferred or transacted at the arm's length price, yes, disclosure is required. Okay. You have to mention why these two parties are related party. Okay. Here is individual directly or indirectly controlling the other one. Is that okay? Clear? So he is controlling the other entity, and being the MD also is controlling the other entity. MD banner helps him to control one entity, and shareholding banner controls the other entity. Then those two entities are managed by MD means, and he has the power to influence these two if there is any power. Related party disclosures must. Clear? Now, A Limited has two associates, B and C. B and C. And owns 25% voting power of B Limited. Here 25% and 30% voting power in C. Would B Limited is considered as a related party in the financial statement of C Limited. Now the question is, what about these two? What about these two? Okay. Now, what sort of relationship we have? Business associate relationship. A being the business associate for B as well as business associate for C, and these two are fellow associates like. Fellow subsidiary like, here fellow associates, so related party you have to disclose. Question number 3. Here they will be called as co-associates. Yes, of course, related party. And identify the related parties in respect of all the enterprises mentioned under AS number 18. Okay. X Limited holds 51% share in Y. Y Limited holds 51% in Z. O Limited holds 49% in Z. Right. Now tell me. For X, I'll write here. For X, Y subsidiary company and Z also subsidiary company. First case direct, second case indirect. Okay. And no relationship with O. There is no relationship between X and O. And in case of for Y, X being the holding company and Z being subsidiary company. For Z being X and Y are holding company, direct holding, indirect holding. And for O, Z being business associate, and here O being business associate. Between these two, they will call themselves being the business associate. Significant influences there. Hope you will be now able to understand X angle, Y angle, Z angle as well as O's angle. So with that, related party transaction is over. Okay, case number 18 is over. Let's see. We'll start with EPS. Earnings per share. Earnings per share. So earnings per share is nothing but earnings available to equity shareholders divided by number of equity shares. That you know. If the earnings available to the equity shareholders being 1 lakh, a number of equity shares being 10,000 means every shareholders for every share they will get 10 rupees. This is called EPS. Clear? But see, this is 1 lakh is nothing but earnings available to the equity shareholders. Now they have 5,000 shares. 5,000 shares, 10 rupees face value paid up 10 rupees. They have another 10,000 shares, face value 10, paid up being 5. So here 5,000 and here, as it's a partly paid up, you have to find out to that part into the whole number. For 10 rupees only 5 rupees paid means for 10,000 it's only partly paid up means it's equal to 5,000 fully paid up share. 10,000 into 5 by 10, 5,000 fully paid up shares like. And if you total this, 10,000 will be the total number of full equity shares. Otherwise this is called weighted average number of equity share capital. Hope you will be now able to understand this logic additionally. Clear? Second one being, you may issue the shares the half of the period. 5,000 rupees, 5,000 shares, 10 rupees paid up, face value being 10, another 5,000, 10 rupees for 10 rupees. But this share exists from the day 1 of the year 2024, 1/4/24. And this 5,000 issued only on 1/1/25, year end being 31st March 26. 5,000 share exists round the clock for the entire year. Another 5,000 issued only on the 1st January 25. And how can you calculate? So for the 5,000, no problem. Another 5,000, you know, since the date of issue for the year end, how many months are there? Only 3 months. So into 3 by 12 will be taken. So 5,000, this will be 1,250. 6,250 will be the weighted average number of shares. Number 1. You have to understand. How do we calculate the EPS? The earning per share, what we have calculated here is nothing but earnings available to the equity shareholders divided by weighted number of shares. How do I calculate the weightage? It may be partly paid up shares or it may be issued part of the year. Issued only after a part of the year. In that case, you have to equate to the fully paid up for the whole year, like you have to equate and then calculate. This is called basic EPS. Not only that, you have to understand what is called diluted EPS also. What is called diluted EPS? Understand, this is the scenario. 10,000 by 10 will be the answer. Earnings available to the equity shareholders being 1 lakh, number of shares being 10,000. But in the next year, currently I have probably 10% debenture, 1 lakh. I'm going to convert that into 5,000 shares at the rate of rupees 10 each. So if you are being the debenture holders holding 1 lakh rupees worth the debenture, you will be getting 50,000 rupees worth the share. Another 50,000 may be securities premium. So how many additional shares I am going to issue for the debenture holders in the coming year? 5,000. Coming year, not this year. Now tell me, if you are planning to purchase the company share, you thought this company gives you 10 rupees return, happy, good share, you invested. Next year, the 10 rupees EPS you expected, now you got only 7 rupees. What will be your reaction? Sir, I invested only believing that you will give me 10 rupees return. But suddenly in the next year, you reduce to 7 rupees, sir. Then he will tell, no problem. The reason is this one. What's that? I have converted the debenture into the equity share, so they are also climbing. Then denominator value is increasing. They are also climbing. That's the reason. If this is the reason, you could have told me already, no, I may be careful investing. So you have to give the awareness that the 10 rupees what you earn in this year may not be available the next year due to some reasons. Due to some reason means that due to some reason, if it is so, then what could be the scenario? See here. In this case, the number of shares will be not 10. The next year you will have 15,000 numbers. 15,000 numbers. What about the numerator? What about the numerator? Is it 1 lakh or is there any change? Because of converting the debenture into equity shares, you will not pay interest in the coming year. For that 1 lakh 10% means 10,000 don't pay the interest. If you don't pay the interest, earnings available to the equity share holders will increase in numerator. Now what is the revised value? 1 lakh 10,000 divided by 15,000. 7.33. 7.33 will be your answer. 7.33 will be your answer. So I tell you, this year basic EPS is 10, but diluted EPS is 7.33. Means in the incoming year there is a chances to reduce because of this action. Or in the next year I suppose to issue the bonus share 1:1 ratio. What happens? If I issue the bonus share, the profit will not be changing, but the denominator shares are increasing. 10,000 for every one share, one bonus share means 10,000 becomes 20,000. Then your EPS being 5 rupees. Tell you 10 rupees is the EPS, but diluted EPS in the next year may be 5 rupees because I am issuing the bonus share. The denominator number is increasing. The same EPS will not exist in the coming year. So diluted EPS case. Potential earnings available to, so I am adding what? Potential earning because of converting what is a change in the earnings to the numerator. In denominator, it's not weighted average number of shares, it is a potential number of shares. What could be the change in the equity shares number in the coming year? Okay. This is the logic. And in what other cases it may be diluted? Bonus shares, debentures, preferential conversion, and some debt for that settlement is in the form of shares. N number of actions are there. Due to that, the dilution may happen. See, I may issue fresh share in the coming days, conversion of debt. These are the natures are possible for or example purpose. So in this case, I am going to solve the illustration one after one. Then later on, I solve the theory. Okay, let's start with the first question. Let's start with the first question. Come on. Calculate weighted average equity shares. Calculate the weighted average shares. Following information is provided by PINA Limited. You are required to calculate weighted average number of shares. Year end being 31st March 2021. This one remains for the whole year. Okay, whole year. This one, come on, July to this period. 9 months, I think, right? 9 months. So, give the weightage for 9 months only. 675. 675. Okay, 675. And the last one, 0 month. So, 3,675 will be the weighted average number of shares. Clear? Shall I move on to the next one? Very simple, no? So we'll see the next one. Okay. Next question. SSD Limited Company had 1800 equity shares outstanding on 1120 fully paid share. So 1120, they have 1800 shares paid up fully, no problem, paid up fully. On 31/10/2020, it issued 600 shares. When? 31/10/2020, they issued 600 shares, 10 each for 5, but payment being only 5, partly paid up. Calculate weighted average equity shares as on 31st December. How many months are there? Whole year. For this, how many months are there? 2 months. So into 2 by 12. And what is the final value? 1800. 300 into 2 by 12, 50. So 1850 will be the answer. 1850 will be the answer. Is that clear? Shall I move on to the next one? Now, now, see here. It's a comprehensive illustration. It's a comprehensive illustration. I may work out separately here. Net profit for the year 2021, 20 lakhs, and 2021, 22, 75 lakhs. Number of equity shares outstanding on 31st December 21, the first year end, 20 lakhs. Bonus issue on 1st January 22 was 1 share for each equity shares outstanding on 31st December 2021. So 1:1 is the bonus share issue. For the year 2021, you have to calculate basic EPS. Apart from that, any change happens the income and number of shares in the coming years expected. And then in this year, you have to prepare diluted EPS. Hope you will be now able to understand basic EPS and diluted EPS. For the year 21-22, you can calculate the basic EPS based on that year's revenue. Can we calculate the diluted EPS for 21-22? No, because unless you get the details regarding what happens in case of earnings available to the equity shareholders and number of shares in the coming year due to the bonus shares or conversion of debt or issue of the right shares or fresh issue of shares, if that information is silent, you cannot calculate the diluted. So whenever in the incoming year, if there is any dilution possibility, you have to mention that in this year in the name of diluted EPS. Then basic EPS being earnings available to the equity shareholders for the current year divided by number of shares we have by the time 20. Now the value being 1.25. Now diluted means I assume there will not be any change in the income. If the debenture is converted into equity, interest is there and share also there. interest savings and share. Preference share capital converted into equity share. Preference dividends sharing will be there and number of share also increasing. These two will have the impact on the earnings available to the equity share. But in case of bonus share, you don't get even any single paise. Only number of shares are increasing. There is no change in the income, only share increase. You have to correlate whether will it have affect the numerator and denominator both or only denominator. In the case of bonus share, it affects only the denominator. Now 25 lakhs in denominator 40 lakhs bonus share. Then the value being 0.625 is the diluted EPS. This year I will offer you 1.25 EPSR, but don't expect the next year we offer only 0.625 because we are offering the dividend, means bonus share. Because of the bonus shares, denominator will be increasing the next year, so don't expect the same EPS in the next. Okay, I am giving the warning. What happens in 21-22, sir? In 21-22, the earnings per share being means earnings available to the equity shareholders being 75 lakhs in that year. What is the number of shares in that year? Now bonus share is already included, so 20 plus 20, 40 lakhs is the denominator value. Come on, tell me. 1.875. Is that clear? Hope now you'll be able to understand. Basic EPS with the bonus shares. Basic EPS with bonus share. So we have completed bonus share scenario. We have the debenture conversion into the equity share scenario, preference share converted into equity share scenario, right share issue in the coming days scenario. Those are the scenarios we have. Okay. Next question, we started with the bonus share scenario. Bonus share scenario. Now, second illustration is all about debenture based scenario. Let's see. Okay. Here 1 lakh 6% debenture issue was sold on April 1, 2020, convertible into 10,000 shares of equity shares. Shares of equity shares. Assuming that net income is 2 lakhs, weighted average of equity share being 1 lakh, and the effective tax rate being 40%. Calculate EPS and diluted EPS. For the current year, I have to calculate the EPS. EPS is equal to earnings available to the equity shareholders. Okay, 2 lakhs. Number of weighted average number of equity share being 1 lakh. So EPS being 2 rupees. Now, what about the diluted EPS? Diluted EPS. Okay, diluted EPS. Okay, once again. In case of diluted EPS, what could be the change in the revenue? What could be the change in the number of shares? Should be includable. Should be includable. Because of this conversion, the number of equity share increasing being 0.1 lakh. 0.1 lakh. Because of this reason, for 1 lakh, you save 6% interest payment. Okay, you save 6% interest. But 6% interest, 6,000. In the case of interest, you can debit to the P&L account. If you are debiting, 40% tax savings will be there. No, now you are losing that benefit. So minus tax, minus 40%. Actually, your income will increase by how much? Okay, 3,600. Okay, see, if interest becomes your income due to this one, no other way it will not be for equity shareholders because you have to pay the tax. How much is for the equity shareholders hereafter? This amount saved will go to the equity shareholders only after the tax, which is 3,600. So in numerator, this will increase only by this much. 2 lakhs 3,600 divided by 1 lakh 10,000. Come on, get me the value. Get me the value. 1.89. 1.89. Clear? See, see, here the 40 lakhs is nothing but 20 lakhs plus 1:1 bonus share, no, another 20 lakhs is added. So that's how the 40 lakhs is coming. In this illustration, I thought the debenture issued in the day 1 of the next year, but the debenture issued on which date? Converted in which date? April 1, 2020. So April 1 means 1/4/2022, year end being 31st December 2020. Only 9 months. So now calculate interest for the 9 months, 4,500, tax payable on that being 1,800, 2,700 only be increasing to the shareholders. So increase in earnings available to the equity shareholders being this much. And you have to find out the weighted average equity shares. Number of equity share capital, since the day 1 being 1 lakh, another 10,000 will be from which date? From this date only 9 months. So this will be for full year, this is for 9 months. So this is 1 lakh and this will be 7,500. The overall value being 1,07,500. 1,07,500. So here the value being with the 2 lakhs, add 2,700 in denominator 1 lakh and weighted average converted equity share being only 7,500. Hope the value being 1.89. Here 1.85, right? Okay. If the debenture converted into equity shares in the day 1, then the first calculation is correct. But here the conversion happens on 1st April, 3 months later. Clear? So we have completed this one. Bonus is over and the convertible debenture case is over. What happens in case of right share? So it involves some extra calculations also. You have to be careful here, especially for right. Especially for right. Okay. Let's see this illustration. In case of right shares, first duty is to calculate right factor. See, if you issue share for cash, will it affect or dilute the share? Means EPS? Definitely it will not dilute the EPS. Because we are getting the cash. Cash is invested in the business. Whatever the investment done there, you will get return, no. So there will not be chances of dilution. If there is no dilution, you no need to do anything. After the change, the EPS should reduce. That is called dilution. In case the EPS is decreasing, you have to state it properly. If it is not decreasing, you don't state it at all. Okay, you no need to state. Otherwise, you have to reverse. That is called anti-dilution. In case of fresh issue, definitely you will get the cash and you are investing in the business, and for that investment, you are getting the returns. You are getting the returns. So you no need to worry about that. You no need to worry about that. In case of right share, market price may be 10, issued to the existing shareholders for 9 rupees, 1 rupee lesser. That will be considered as a bonus component. Bonus share confirm there will be dilution chances. But in the case of fresh issue at the equivalent cash in the market price will not be having any dilution. But issuing the right share with the discounted price in the market compared to the market, there will be definitely dilution, but not equal to what? Bonus share or not equal to like a similar issue price. But there will be small component related to the bonus, no? So you have to identify what's the bonus component here. That's your duty here. I'm going to solve this illustration. Here, in case of right share, what are the points you have to understand? Number 1, you have to apply the right factor. You have to apply the right factor, okay? Or find out the right factor. Step number 1. Number 2. Potential weighted average number of equity share capital being average equity share capital will be weighted average equity shares exist already, multiply with this right factor. Third, how can you calculate the weighted average equity shares, number of equity shares in the next year? Means in the year of right issue. How to calculate? These are the 3 components you have to be mastered for handling the right shares. Finding the right factor. There will be impact in the weighted average equity share capital to the extent of small portion that is called bonus component. That bonus component is called right factor. I am using the right factor to find out the potential equity shares. In the next year, the original issue happens, how can we calculate? So these are the 3 components you have to understand. NEEL Limited issued 5 lakhs equity shares of rupees 10 each, fully paid, amounting to rupees 50 lakhs. It issued right shares among the existing shareholders on 31st July 2021 in the proportion of 1 new share for 2 outstanding shares of rupees 50 each. 1 for every 2 share. Shares held. If you hold 2 shares, how many shares you will get? Right shares you will get being 1. After the right share, total number of shares you will hold being 3 number of shares. And when the right share is going to be issued? 31st July 2021. In the proportion of 1 new share for every 2 outstanding shares at rupees 50 each. Issue price being 50. Current market price of the company share prior to the right issue being 90. That's called cum right price. This is called cum, cumulative of right price. Cum right price. Cumulative of right price. 90. Right share being 50, share held being 90. Clear? So, if you are being the holder of this company's share, 2 numbers, 2 into 90, 180, you have the options to purchase 1 more share for rupees 50. Then what about the total amount you paid for purchasing the 3 shares? 230. It means, what about the average price you paid? What is the average price you paid? 230 divided by 3. 230 divided by 3. 76.67. This is called cum right price. X right price. This is called excluding right price. X right price. So how can you calculate the right factor, sir? Right factor, the first point. Right factor is equal to cum right price divided by X right price. This is what about the right factor. Cum right price being 90, cumulative 90. After right issue, your price decreases to 76.67. Then the right factor being 1.1739. Clear? This is the right factor. Step number 1 over. Net profit before tax for the year ending 31st March 21 and 22. So for the year 2021 and 21-22. For the current year only, you have to calculate what? Basic EPS and diluted EPS. Okay, for the next year, you will calculate only what? Basic EPS. In this basic EPS, for the year 2021, your profit being 11 lakhs before tax, corporate tax being 30%. Subtract 30%. Then what is the profit after tax? 7,70,000. 7,70,000 is the earnings available to the equity shareholders. Divided by, what about the number of shares? Now you have 5 lakh shares. Then EPS in this case being 1.54. EPS being 1.54. Because of bonus share, there will not be any change in the revenue. Right issue, no. It has some bonus component. That bonus component is called 0.1739. 1 rupee is the original value, 0. That excess number you have beyond 1 is called bonus component. To that component, there will not be change in the revenue, but in denominator, number of shares may be increased. So then, 7,70,000, the revenue remains the same after the issue of the bonus share, right share. In the denominator, to the extent of bonus component, the number of shares will be inflated. So, which is nothing but 5 lakhs into 1.1739. Now, find out the ultimate value. 1.32 is the diluted EPS. 1.32 will be the diluted EPS. One point 31.32. Okay. 1.32. Okay. Now, Now, 21-22, how to calculate for the year 21-22? In the year 21-22, the profit being 13,50,000 rupees minus 30%. What's the value? 9,45,000. 9,45,000. In the denominator, potential weighted average number of shares. Now there is a issue of new shares also. Is that okay? So year beginning will start with first April 21, ends on 31st March 22. While starting, we have how many shares? 5 lakhs. Thereafter, right share issued on which date? 31st July. 31st July 21. One share issued for every 2 shares. Now hereafter you have 7.5 shares. I included the right shares also with this. Okay, 5 plus 2.5. Is that okay? Now from here to here, how many months are there? Okay, 8 months. So into 8 by 12. For this one full year, but don't forget, here there is a bonus component, right? Bonus component being 0.1739. So you have to multiply with that 1.1739. Okay. And how many months are here? So I am calculating only for this period, right? Rather than calculating for the whole year, you can calculate for this in this model. 5 lakhs into 1.1739 number of shares you hold from 1/4/21 to 31st July 21. From this date to this date, you have 7.5 lakhs shares. This will be assumed to be a part of bonus share included here. So 5 lakhs into 1.1739 into how many months here we have? 4 months. So into 4 by 12. 4 by 12. So total being 12 by 12, right? So come on, get me the value. 1,95,000. 15. 650. Okay. 650. What about this one? 5 lakhs. Okay, 5 lakhs. And total being 6,95,650. 6,95,650. Now what about the basic EPS in this case? 1.36. 1.36. So 3 points to be noted here in case of right issue, right factor calculation. Right factor is calculated this way: cum interest price divided by x interest price. Okay, cum right price and divided by x right price. Second being how this will have the impact on the potential weighted average equity shares. Third being in the year of issue of right issue, how can we calculate? Up to the date of issue, number of shares is multiplied with the right factor. After the issue, total number of shares for the remaining period, you can apply the weightage. So these are the 3 points you have to understand in case of right issue. Is that clear? Yes, make note of it. Next one is all about option based. Okay, rarely it comes, that's why I am guiding you. Option based. Don't get confused with the terminologies and all used here. Calculate EPS and basic and diluted with option shares. Okay. Net profit for the year 21, 6 lakhs. Weighted average number of equity shares during that period, 2.5 lakhs. Average fair value of one. So then if you divide this, what you will get? Basic EPS you will get. How much is that? 2 rupees 40 paise. Average fair value of one equity shares. This is what about the fair value, market value 20. Weighted average number of shares under option, 50,000 shares supposed to be issued in option. While using the option, buyers are paying only 15 rupees. Exercise price for shares under option is only 50. This is what about the issue price. 20 rupees share issued for 15 means the difference between these two 5 rupees is considered as bonus component. So in this case, how can we add? So for the next year, diluted EPS, potential earnings available to the equity shareholders divided by potential number of equity share capital, weighted average equity share capital. Okay. Numerator, there will not be any change because you are issuing at a discount value. Denominator, already you have 2.5 lakhs. Now, further you are issuing 50, but it is not cash. Out of this issue, how much is for non-cash? How much? For every 20, 5 rupees is non-cash, 15 rupees is cash. Balance 5 rupees being non-cash. Only non-cash portion will be considered as what? Bonus issue. So into 5 by 50, 20. 5 by 20. Then 2,62,500 will be the denominator value. 6 lakhs divided by 2,62,500. What's the final value? 2.286. Hope you will be now able to understand basic and diluted EPS. Is that clear? This is what about the option case. Debenture, like you have the preference share also. You can easily understand. So with that, all the illustrations over. Now let me finish up the theory here. Okay. Let's see. If it is clear, text me. So we'll go for discussing some theory here before we go for other chapter. Now, so I started with what? Explaining what is called basic and diluted EPS and also explain in detail. Note, potential equity share must be ranked in order of dilutive nature. What does it mean? See, I suppose to convert the debenture into equity shares, preference share capital into equity share capital, plan to issue right shares and bonus share also. All the four will have the dilutive nature. Dilutive means it will reduce the EPS. Suppose existing EPS being 10, because of debenture to equity share capital, it becomes 9. Separately, because of preference share, the dilution being 9.5. Because of the right issue, the dilution being 8.7. Because of the bonus share, the dilution is 6. So among the four, which is the most diluting nature? Bonus share. So you have to find out the diluted EPS based on the bonus share first, second this one, third this one, fourth this one. This is the order. Okay. See, this one being the third one and this is the fourth one. First, second, third, fourth. The transaction which has more dilutive effect will be diluted first. But if there is no dilution, sir, it remains higher than the earlier value, skip it. Ignore in case of anti-dilutive. Anti-dilutive means it seems to be reverse order, so you don't need to worry about that. Now you have to understand what is called potential equity shares. Already told you know. Debentures or preference shares converted into equity shares. The number of equity share capital may be increasing. Options already we have studied, including bonus shares also. Including bonus shares. Any other warrant like given also be a reason. And contingently issuable shares for some contractual arrangement. I suppose to issue 1 lakh shares to somebody else, probably ESOP like, or any loan borrowed. For that I have to offer only equity shares, contingently issuable. All these things will be called having impact on the number of equity shares. So definitely denominator will be changing. Relatively, is there any change in the numerator? That should also be adjusted. After calculating whether the EPS is decreasing or increasing before this. If it is increasing, that is called dilutive, otherwise it is anti-diluting. Anti-diluting, you forget it. You don't need to do any more adjustments. In this case of anti-diluting, basic EPS and diluted EPS both are same. This is 10, anti-dilution means this diluted EPS being 12. What you can do? Write this as 10 only. Write this as 10 rupees only. Now, we calculated the weighted average equity shares, right? If the shares are issued in cash, how do you apply the weightage? The date of issue. If the share issued on 1st January, we calculated from 1st January to the period end, 31st March, only 3 months. 3 months weightage is there. If the share is issued in cash, weightage will be given from the date of receipts of cash. Or I borrowed 1 lakh rupees, then that 1 lakh rupees is now converted, borrowing is converted into equity shares. Okay, when the loan ceases in your balance sheet and converted into the share now, from the date you can apply the weightage. Okay, the conversion happened on 1st October. So from the 1st October to 31st March, you can have that weightage. In case interest and principal of debt, you borrowed money, you have not paid interest also, both accumulated, 1 lakh borrowed and together with interest now it becomes 1 lakh 40. Now I told the borrowers don't rise hereafter. You can convert that into the equity share capital. For 1 lakh 40,000 rupees, I am offering the equity shares. Once a share is offered, thereafter they will not charge any interest. Means when the interest ceases to occur, hereafter I don't charge interest. That date, from the date weightage would be taken. And in exchange of liability also same. Fourth one you can cancel because liability and debt are same. In exchange of asset, you purchased an asset and then for the purchase of asset, you offer the shares. In that case, when you actually acquired, acquisition recognized, when you are going to write this asset as your asset in your balance sheet. If you are writing the asset purchase as on 1st January, from 1st January onwards, you can apply the weightage. And similarly, it's not only asset, it may be for goods, it may be for services. You don't need to work out separately, everything can be grouped here. In case of partly paid up, since the date of cash received, to that part only apply. We have seen no. So 5 rupees paid out of 10 rupees means you have to calculate to that extent. Only 2 months means 2 by 12 is applied. So fraction in the ratio paid up face value. Fraction in the ratio paid up. That's how weightage is calculated. In case of amalgamation, we have studied that amalgamation under AS number 14. Amalgamation, the nature of purchase and merger. So we had two methods earlier, we referred. Sorry. In case if you go for purchase method, what does it mean? Existing company is completely closed, that comes under the control of the buyer completely. Merger means we both join and continue the same business. It's a mutual. In case of mutual, the weightage will be taken from the day one onwards, day one of the year. In case of acquisition, it's acquisition like from the date of acquisition, weightage will be taken. Okay. Now, In case of right issue, what happens? In case of right issue, we solve the illustration. Right factor is used. Right factor is used. Bonus share. Always bonus shares, share split, always full year. Contingently issuable share. For some commitment, I have to issue the share, like loan or whatever it may be. As per the agreement, when we supposed to issue will be the date. 12th will be taken. Equity shares issued. Clear. Hope you will be now able to understand this one. Clear? Now, how do we calculate the right factor? Also we studied disclosure. You have to disclose the method of computation of EPS and NPS, diluted EPS, everything. That's all. With that, EPS calculation chapter is over. AS number 20 is over. Clear? We'll now move on to the next chapter. Discontinuing operation. AS number 24. Discontinuing. Like segment reporting, you have 3 or 4 different segments. You propose to discontinue one of the segments in due course within 2 or 3 years. If you completely sold off, forget about that. It's no more your entity. It's part of your segment. You're supposed to discontinue in a matter of 2 or 3 more months. 2 to 3 more years. As you plan to close this within 2 to 3 more years, you want to know what is the financial result of this for the 3 more years. That will be shown separately. In your company final accounts, you might have seen that profit from the continuing business, profit from discontinuing business, and total business profit. So here you have 3 segments where you plan to discontinue. C means you have to find out first of all profit from these 2 separately shown, and it's your duty to show the profit from C also separately and then group and give the total value. Because as you plan to close C, why do you close C? Because it's not profitable, or sometimes later it may not be viable. It's not logical at all to run hereafter profitably. So I expect so, then I want to discard that. That is called discontinuing operations. So this is number 24 applicable for discontinuing operation. We are talking about discontinuing operation, not a discontinued operation. Already discontinued, forget about that. It's supposed to be discontinued, then we can do it. It's a component of an enterprises. It's a segment of an enterprises. Right. Now, how can you plan to discontinue this? 3 years later, sir, this C division is going to be transferred to Mr. X for 5 lakhs or 50 crores, whatever it may be the amount. No, sir. That C division part asset may be saleable in the next year. Thereafter, another. Otherwise, I downsize my operation. 100% operation was carried over earlier. Now I plan to go for 70, subsequently 60, and then 30. Later on, it's going to be closed completely. Whether it is being single plan, disposing substantially in its entirety, like a demerger and spin-off, that entity is totally removed and formed a new one. This is also falling under this case. When 3 years or 4 years later. Now itself I have completed, sir. Forget about that. It will not come under AS number 24. When AS number 24 is applicable, supposed to be discontinued in a matter of 2 or 3 more years. And this is single plan. Piecemeal disposal. But must be a single coordinated plan. Also be considered a single plan. Okay. So A, B, C. I agree to transfer the C to Mr. X. Okay, for this I get 10 crore rupees. I get 10 crore rupees. Okay, clear? Or I transfer this, we fix the price 10 crore. First I transfer 30%, you transfer 30%. 3 crores give me, one division is, one part will be transferred. So piecemeal disposal, but we have already planned completely in single coordinated plan. Abandoned. Another one is abandoned. That C division, whatever the revenue comes, I never bother. Comes means okay. If there is a loss, I never bother. That's all about abandonment. I don't care to make it profitable subsequently by investing additionally. only if he satisfies criteria for discontinuing operations. Okay. In the case of abandonment, the criteria should be satisfied. What is that? Abandonment. Okay. Completely stopped the division. Forget about that. That's called abandonment. But stop it. Whatever the revenue I'm generating using that particular division without my care, I will be happy to take. So at least 3 more years it will generate some income without additional investment, means that will come under single plan. Completely stop, I don't get even single plan from that, means it is not coming under discontinuing operation. So what are coming under discontinuing operation along with single plan? Completely sold off, like demerger and spin off, and one single plan for total consideration, but transfer happens in piecemeal. Abandonment, but whatever the revenue I get from that, I may wait to get it for at least 2 or 3 more years. These things are called as single plan. Note, changing the changing the scope of operation is not falling under abandonment. Okay. Changing the scope of operation. Scope of operation means you already manufacture and sell at 100% capacity. This year you're supposed to reduce to 90. Sometimes later you want to extend to 120 by overtime. Okay. So if you are reducing, then it is not considered as, it's what about operations increasing. One additional work also be carried over. That is called changing the scope of operation. It's not abandonment. It's not abandonment. It can be taken. Number 1. Number 2. This may be a separate major line of business. Maybe business or geographical segment already. So what entities are already explained. ABC means C may be one of the segments. Like, how can you say this being the segment? AS number 17 has guided you. Define under AS number 17 are a part of segment. So either A, B, C. This is identified under AS number 17. We plan to discard this one. Okay. In C, only a portion is going to be discarded. That is also possible. Maybe a part of the segment. May not be a reportable segment. It may not be reportable also. Not necessarily it should be reportable as per AS number. May be reportable, non-reportable. Both the segment may also be discontinued. 13th. Discontinued operationally for financial reporting purpose. It is only financial reporting purposes. Discontinued operationally. Okay. Now, some examples are there. Gradual phasing out of product line or class of service. Not discontinuing operations. You might have seen toilet soap, shampoo. Currently, what happens now, the same box or style of packing may be differentiated. Some extra flavor is added. I have not seen the same default product saleable by the same vendor for a longer period. Because customers are expecting some changes. At least there will be change in the bottle's shape. Okay. So those things are changing some product line from this one to that one. So basic product and fragrance product, or in that fragrance sandal product, rose product. That's how they are changing. Still it is only the same product, shampoo. Is that okay? So it's nothing but slowly phasing out one of the product and shifting to the another product. You have the same manufacturing facility. So you have the manufacturing facility to produce a shampoo general. Now the same facility is used for fragrance plus, like, okay, also be considered as a not discontinuing operation. Discontinuing, even if relatively abruptly, several products within an ongoing line of business. Several products. I have 10 products. Suddenly they stopped producing 7 products. Will not be considered as discontinuing operations. Discontinuing operation. Okay, means from this it is very clear that particular facility itself non-operational, then it is called discontinuing operation. I have a machine, using the machine I can produce a B, C, D. For all these things I have only one plant and machinery. Suddenly I stop all these things. Again, this plant and machinery completely used for A only, no. This plant and machinery remains with that. This operation remains intact. So it is not discontinuing operation. It's only product discontinuations. It's not operation discontinuation. One of the product discontinuation will not be considered as the discontinuing operations. Okay. Shifting. So Singar Academy started with the coaching for CA, CMA and CS also. Sometimes later I planned not to go for CS coaching. So we stopped. It is not stopping the operation of Singar Academy. Singar Academy's facilities existing there. It is operated there. One of the thing is stopped. Okay. Closing of facility to achieve productivity also be not considered as discontinuing operations. Okay. So I have to work A, B, C. There is huge demand for A. Because of the reason temporarily I stop this or permanently stop this, the entire resources is shifted to manufacturing A, also not considered as discontinuing operation. The facility is stopped, then it is called discontinuing operation. Now, in the very first year, in the year 25-26, I want to mention that division C is going to be discontinued in 28-29. In a matter of few years later, by the end of 2029, I want to discontinue completely. But in the year, I made a decision. Then how can we handle? Initial disclosure, in the initial year, how can you disclose? Whichever is earlier of agreement to sell substantially all assets of discontinuing operation, approving or announcing the plan by the board of directors or similar body. Once you plan to sell, now the question is it approved by the board of directors? Or buyer said, okay, I will take up. Okay, buyer, sale agreement. Okay, sale agreement is done. So, board of directors planned, okay, we can close on which date? 1/1/2026. Buyer is also accepted to take, sir, I will take if the board of directors permits. So, this happens on 1/9/2025. Between these two, whichever is earlier, 1/9/25, you know, from the date onwards, you have to disclose separately to the operations. The operations you plan to discontinue. Is that okay? It may be a formal plan to discontinue. Okay. For discontinuance, normally includes what will be there. So, when you have to start disclose, which is the initial year, between these two, whichever is earlier, this date will be considered as initial date of disclosure. And what could be the formal plan? Identification of major assets to be disposed of. In that C, what are the major assets to be disposed of? And how do you dispose? Method of disposal. Is it going to be scrap or sold or diverted to some other entity? Period expected, how many years? So I told you, from here to here, a few years or 3 years or 4 years. When you complete this, and which location affected, and the location function, approximate number of employees terminated due to this, the estimated proceeds or salvage value realized on disposal. All these details are going to be disclosed with respect to the discontinuing operation in the very first year. It's a purely theory only. There is no any complicated illustrations available here. So let's finish a bit faster. Okay. Now, okay. Here there is no measurement. Okay. Small ideas only. So now recognition, measurement. Okay. Recognition and measurement. Initial disclosure, other disclosure in the very first year. Year on year, you have to update what is a change up to and including the period of discontinuing gets completed. We plan to discontinue in 3 years. First year end, you say 1 year completed. By the end of second year, 2 years completed. Another 1 more year is to go for completing this one. So that is what of updating disclosure. Okay. What about interim financial report, sir? In case of interim financial report, you have to disclose in notes form. So, for the year 25-26, you have to prepare the financial reports by the end of 31st March 2026. Am I right? Not necessarily you have to wait for the entire year. Once in every 3 months, you have to report. Okay, that's called quarterly reporting. Okay, so 1/4/2025 to 3 months, 36/2025, 1/7/2025 to 39/2025. So you have to prepare financial report for this quarter, and then 1/10/25 to 31st December 25, and then 1/1/26 to 31st March 25. So this quarter and this quarter. This is what about the yearly report. This is what about the quarterly report. For this quarter, This will be for the entire year. Okay, for the entire year, you will give more details. In case of every quarter, you just give a note only. Any significant activity or even relating to the discontinuing operation happens, then you give just note. Change in the amount or timing of cash flows also be intimation is given if there is a significant activity, else you forget about that. Clear? Now, what about the disclosure, sir? Already we studied, the same is almost repeated. Discontinuing operation, whether it's a business or geographical segmentations, date and nature of initial disclosure, period. So what you already studied, you know, whichever is earlier, this is the period, you have to disclose these things. Apart from that, you have to value what is the worth of this particular discontinuing segment. Okay. Currently, what is the profit generated by this segment? Carrying amount of the particular segment in your balance sheet, associated liabilities, revenue and expenses, pre-tax profit and tax expenses and net cash flow attributable to this, all these things should be disclosed. While preparing the financial statement, you prepare no profit before discontinuing, profit from continuing operation, profit from discontinuing operation. That's what about the requirement of this. Clear? So with that, we have completed the discontinuing operations. AS number 24 is over. We will now move on to the AS number 25. AS number 25. Okay. Interim financial reporting. AS number 25. Interim financial reporting is the report you have to prepare normal balance sheet like income statement like for every 3 months. Interim period. A financial reporting period shorter than a full financial year. Currently we have 3 months for Indian requirement. Not interim period. In case first year of the operation of an enterprises, its annual financial reporting period may be shorter than financial year. The very first year, you know, they started the business exactly on 1st November 2025. Year gets over on 31st March 2026. Don't prepare separately for 31st December 25 and this one separately. As the first year is shorter than 12 months, you no need to prepare the interim reporting, financial reporting. Interim financial reporting, usually the reporting period is less than a year, generally 3 periods. Okay, 3 months. Now, what about the form and contents are same like final accounts. What do you do? Financial reports, right? Financial statement, okay, which is similar to the annual report. Income statement, balance sheet, notes to account, cash flow statement, all. If you are able to prepare completely, happy. Else, at least you can give condensed financial statement, which has some limited information. Currently, all the listed companies will go for complete financial statement only. With the selected explanatory notes, additional line items or notes should also be included if it is material. And EPS is presented as per AS number 20 in annual report. Okay, diluted and diluted and basic. Interim report should also be presented as per AS number. So AS 20 is applicable for the interim financial report also. Is that okay? Means for every 3 months, if you are preparing any EPS and basic EPS and diluted EPS, in the next 3 months, if there is any dilution, you have to give the information. Is that okay? No. What are the selected explanatory notes you have to follow? Selected explanatory notes. Minimum disclosure required. At least basic, you need to give these details. If you are able to give the complete details, well and good. At least you have to give this one. What are they? Any accounting policies changed, then you have to give this. If there is any seasonality, for example, during the Diwali season, garments business will be quite higher. So if you want to disclose the result of Diwali season, you have to intimate that this is the Diwali season due to this reason, the profit compared to the previous season may be 10% or 20% higher. That's how you can give the intimations. Any unusual factors as per AS number 5 you have to follow. Okay, we'll study that AS number 5 later on. Okay, and changes in debt or equity ratio, any estimate you already followed, will any change happens, so you have to disclose that. Dividend payment, if any, also be shown in absolute as well as in percentage. For example, face value being 10, okay, market value being 100. So they will say 50 percentage dividend is declared in percentage, which is 50% on face value is calculated, which is 5 rupees also absolute. So you have to show in absolute term as well as percentage term. And disclosure of segment information is needed. That is also needed. Effects of changes in composition of the enterprises, of course, needed. Any composition of the enterprises, probably 4 directors now becomes 5 directors or 3 directors. Any change in the directorship also be shown. Any material change in contingent liabilities should also be disclosed. Is that clear? So the financial report for the shorter period is going to be prepared comprehensively or selected model. Now, periods for which interim financial statements are required. For which period? Balance sheet, P&L account, CFS. Okay. Current period. If you prepare for 1st October 2025 and ends on 31st December 2025. This is the third quarter, Q3. This is named as Q3. While preparing this one, what? Balance sheet, profit and loss, and cash flow statement. Parallelly, for the comparison purpose, you have to include 1/10/24, 31st December 2024. This Q3's details should also be included so that the readers will understand what change happened between these two. Okay. End of current interim period, end of immediately preceding financial year. So that's how you can give comparative periods. Current period and comparative period you have to give. And this one year to date. Okay. These are the details you have to give. Year to date, year to date. So balance sheet, end of the current interim period, P&L account, current interim period, and cumulative for the year to date. For this Q3, no, you have to show the P&L account for 1/10/25 to 31st December 25. This is what about the current interim period. Cumulative for the year to date means the year starts on 1/4/2025. This third quarter ends on 31st December 2025. No. If you prepare for the 9 months, that is called cumulatively for the year to date. Year, starting year to the date of closure. Okay. And CFS should also be cumulatively for the year to date you have to show with the comparative period details. Right. Next, materiality you should always be always disclose. Right. Now, in case it is material, recognize, not only recognize, measure and classify and disclose. I skip this one here because already we have studied the materiality where in the accounting principles chapter. If it is being first chapter, right? So there we have seen if it is being material, measurable or not. If it is measurable, quantifiable, you have to mention the value of impact. If it is not so, state the reason. If you are able to guess and also you have to state that. So that will be coming here. It is similar to this AS number 1 we studied, right? It is nothing but AS 1 only. AS number 1 only. Materiality studied there only, right? Okay. Now, we'll see few illustrations in this topic. Very rarely you may expect some illustration also. We'll see. Basic illustrations. Now, Sincere Corporation is dealing in seasonal product. Sales pattern of the product quarter wise is as follows. This is what about the sales pattern. This is the sales pattern. Okay. Now, information regarding first quarter ended on 30th June 2021. First quarter starts on 1st April 2021 and ends on 30th June. 3 months. Sales, salary and other expenses, advertisement, administrative and selling expenses are given here. Clear? Now, while preparing interim financial report for the first quarter, Sincere Corporation wants to defer 10 crores expenditure to third quarter on the argument that the third quarter is having more sales. Okay. So they want to defer the expenses. Out of this entire value, 10 crores they want to charge to third quarter because the sales is huge in third quarter. That's how they are arguing. Okay. Considering the seasonal nature of the business and the expenditure are uniform throughout all quarters, but these expenses are common for all the period. 60 plus 4 plus 8, what's the value? 72. 72 crores remains constant for all the period, all the quarter. Q1 also same, Q2 also same, Q3 also same, Q4 also same. But sales in the first quarter being 80, but the second quarter also be same. Third quarter 6 times. 6 times means 480. Last quarter only 2 times, 160. So they want to transfer these expenses rather than debiting to the Q1's profit and loss, they want to debit in Q3 because huge profit is there. Is it possible? Definitely it should not be done as per the accounting methods. Okay. Because matching concept. Okay. For whatever the expenses for the period, it should match for the period. If there is no payment, it should be named as outstanding and add and show in the P&L account, right? Rent per month 10,000 rupees. For the 12 months, you paid only 1 lakh. For the 2 months rent, 20,000 rupees pending means what is the rental expenses? Not 1 lakh. 1 lakh plus that outstanding 20 should also be added. Don't say, sir, this year our business is very dull, sir. So this may be expenses of the next year. The same logic is applicable for the quarterly reporting also. So the statement argued by them is not acceptable. So 80 crores is the revenue, 72 crores is their cost. This deferment is not permitted. Only 8 crores is their revenue. Clear? Hope you'll be now able to understand this. Next question. Here. The accounting year of X Limited ends on 30th September 2021. Accounting year ends. And it makes its reports quarterly. However, for the purposes of tax, year ends on 31st March every year. So what happens for the purpose of taxation, the year end is different, but they followed different accounting year for the accounting purpose. Because sometimes, head office may be other country, branch office in India. Suppose head office in USA, usually their financial year starts on 1st October. So they followed the same model. Their branch in India also follows the same model. But in India, they have to pay the tax as on 31st March. Okay. For accounting year from this period to this, the quarterly incomes are given here. Now, average actual tax rate for the financial year 31st March is 20%. Financial year ending March 2022 is 30%. Calculate tax expenses for each quarter. Okay, this is the quarterly income. How can you calculate? Now, as per our purpose, tax purpose, 31st March 21 will be current year. Okay, this is nothing but their accounting year. And this will be called as your tax year or financial year for the tax purpose. For this period, tax rate being 20%. For the current tax year, in this tax year, the tax rate is 30%. Now tell me, what is the overall tax you are paying? Here 40, here 40, here 60, here 60. That's how you have to recognize the tax expenses for every quarter. This is the tax expense for the first quarter. This is the tax expense for the second quarter. This is the tax expense for the third quarter. This is the tax expense for the fourth quarter. That's how you can show. Clear? Now, let's move on to the next one. The same, additionally, what about the disclosure, sir? All the disclosures are similar to final accounts, means annual report. Okay, disclosure in annual financial statements. You follow AS number 5 similarly. Okay, similarly. AS number 5 is nothing but prior period items and changes in accounting policies. We'll study that 5th chapter. Anything related to this dealt in another AS also be applicable. So AS also be applicable here as per the same provisions. What happens in case of accounting policies, sir? Whatever the policy you follow for the year, you have to follow the same for the quarterly reporting also. Okay, interim financial reporting also. Follow the same accounting policies for IFR, interim financial report. Except accounting policies, changes made if any. Okay, then for the changes as per AS number 5, you have to make the corrections. Okay. Frequency of enterprises reporting should not affect the measurement of its annual result. Okay. But the change frequency should not affect the annual report. Okay. Rest of the things are the same. Some example we'll see here. Principle for recognition and measurement in an interim period are the same as that an enterprises would follow if it is prepared only annual financial report. What the policy you follow for annual financial report, the same is applicable for the interim period also. Recognize if there is any change in one interim period to the another interim period. See what happens, year 25-26 you followed SLM method depreciation. In the year 26-27 you're supposed to follow WDV method. So then what you have to do? You have to intimate that properly in your accounting records as there is a change which is required as AS number 5. Okay, under AS number 5. Now you just think over Q1 you follow SLM method, Q2 you want to follow WDV method. What can you do? Same like you have to report the change in this quarter. Q1, 1st April to 30th June. You want to change the method of depreciation from SLM to WDV in which Q? Q2. Q2 starts on 1st July and ends on 30th September. If you want to change that in the Q2, you have to report that one also. Clear? A cost that needs future event to meet the definition, okay, an asset should not be deferred, okay. Any payment gives the benefit for more than 1 year, clear, that will be debited to the P&L account. Asset, that will be considered as an asset. If the payment is for the period, debit to P&L account. You purchase the building will work for a longer period, so it's an asset. Pay the rent, you will enjoy that only for a month period, so debit to P&L account. The same. If you purchase the building, it's an asset. I paid for 7 months, but I'm preparing only for 3 months. 3 months is the expenses, remaining 4 months is your asset. Is that okay? Cost for smooth earnings over the interim period of 3 months. This amount you spend for running the business for 3 months, transfer to the P&L account. Cost that meets the definition of assets. No, sir, this will give the benefit for the next year, sir, then that should be capitalized or asset. Income tax is calculated based on the weighted average rate. Okay. Q1 different rate, Q2 different rate. You can calculate all the rates and find out the average rate. In case of salary, okay, employee earns 1 lakh rupees salary. In a year, 12 lakhs rupees is salary. For the first 3 months, up to 3 lakhs, there is no tax. There is no tax. Can I say no tax for the 3 months? No. The moment he reaches 12 lakhs, he has to pay the tax. So you have to calculate the tax for the 12 lakhs and then total tax divided by total revenue is the average tax. You might have studied in taxation, average tax rate. That tax rate will be, say, suppose it comes around 5%. On this 1 lakh, 5%, 5,000 rupees is the tax for the first month. So every month there is a tax, 5,000 rupees. Though it's not payable, the tax is not payable for this month, but for the year you have to pay now, that average tax will be taken. So weighted average tax rate will be taken. Now what happens, sir, if I change the accounting policies? Can I change the accounting policies? Yes, you can change if it is needed, but IFR is disclosed. Already we studied, no, I skip this one. These are things are going to be dealt under AS number 5. AS number 5, see in your text, net profit or loss for the period, prior period items and changes in accounting policies. This will be applicable for the financial report, annual financial report. The same condition will be applicable for the quarterly interim financial report also. So it's correlated accounting standards. You don't need to study here separately. Now, as per that AS number 5, okay, we'll adjust some transaction here. Accountants of Purnima Limited showed a net profit of rupees 7,20,000 for the third quarter 2021 after incorporating the following. Okay, so 7,20,000 is the third quarter profit. This is calculated after these three adjustments. Number one being bad debt 40,000 incurred during the quarter. 50% of the bad debt have been deferred to the next quarter. Will it be possible? The bad debt for the period being 40, but they have debited only 20 in this quarter. They want to debit another 20 in the next quarter. How? Matching concept says whatever the expenses for this quarter, you have to debit in the same quarter. So it should be adjusted. Debit full bad debt. Debit full bad debt in this Q1 itself. Bad debt in Q3. Okay, Q3 itself. Now, extraordinary loss 35,000 happened during the quarter has been fully recognized. This loss is for that quarter only. No, they have to recognize fully what they have done is correct. Additional depreciation 45,000 resulting from the change in the method of change of depreciation, assuming 45,000 is a charge for the 3 quarter only. So if there is any change in the method of depreciation, in the year of change, the impact of change in terms of value also be disclosed and reason for change also be disclosed. Similarly, if the change happens to any of the quarter, the impact in the depreciation value in that quarter should also be disclosed, and why do you change also be stated here. The things what you prepare for the annual report, you have to prepare for the quarterly. That's what about interim financial report. Is that clear? So this topic, especially IFR, interim financial reporting is not a separate chapter. If you are strong with the financial reports, this chapter is. AS number 26, intangible assets. Intangible assets. AS number 26. What do you learn in intangible assets? AS number 26. Any intangible assets you have to find out whether it's your intangible assets or not. Recognition. Measure its value. How are you going to account it in your books? And any assumptions you do about this inventory, means intangible assets valuation, disclose this finally below the balance sheet. Okay? Clear? This intangible asset is not applicable for financial assets like bond, debentures, all these things are called financial assets. For that, this AS number 26 is not applicable. Similarly, intangible assets covered under other AS. Right. AS number 2, AS number 7. If the intangible assets held for sale in the ordinary course of business covered under AS number 2 and AS number 7. Some technical rights I purchase. For example, I am purchasing the Tally softwares and selling the Tally software. So it seems to be intangible assets, right to use. Okay, Tally software. If I purchase the Tally software and keeping this as a stock, then that will not come under AS number 26. AS number 7 is for the construction contract. For them also be considered as held for sale. It will not be dealt under AS number 26. DTA, deferred tax asset. Intangible assets only, we'll study that along with AS number 22 later. Lease assets, AS number 14 and 21. What is that? AS number 14, amalgamation. In case of amalgamation and absorption, you create the goodwill in case of merger method, right? In case of, in the case of purchase method, you calculate the goodwill. In case of merger, you never bother about the goodwill, right? And AS number 21, holding and subsidiary company. Consolidation. In this case, goodwill may arise. That will also be applicable as per that particular accounting standard, not as per AS number 26. Case of expenses for exploration and development and extraction of minerals, oil, natural gas, and similar non-regenerative resources also be not applicable. You paid the royalty as well as you spend the money for finding whether the natural resources are available or not. Okay, once you spend, then you don't have any tangible assets. You find that there is some asset, that's all. So those things will not be coming under the AS number 26, but in case of computer and startup cost will be considered as intangible assets. Computer and startup cost, okay. Intangible assets arising in insurance enterprises from contracts with policyholders will not be part of intangible assets except computer and startup costs. These two will be considered as intangible assets. Leaving these two, nothing will be intangible assets. Hope you will be now able to understand where the intangible asset is not applicable. Not applicable. Is that clear? And where then this is applicable? Advertising, training, startup cost will be considered as intangible assets under AS number 26. R&D also be any R&D you do and then find any pattern or any know-how to start operate. So then automatically this is know-how cost. The know-how will be intangible assets, technical know-how. Right under licensing agreements of moving picture films, video recordings, plays, manuscript. All these things are again intangible assets. Right, licensing, legal rights. Patent, copyright and trademarks are all falling under intangible assets. Right. Intangible assets. Identifiable. Separability is not required. If the asset generates future economic benefits only in combination with other assets also be intangible assets. Okay. Distinguished from goodwill, that is separable for economic benefit. It should be distinguished from goodwill. Okay. C. You do research and development and you found one way of doing technical know-how. Because of this technical know-how, you can do the job much simpler or cost effective. X demands, sir, I want to do as per your strategy, sir. Sir, I cannot give at free of cost. You give me some money. So then automatically technical know-how is now identifiable and this technical know-how can generate the revenue also. Some cases you cannot identify the revenue is generated only due to the technical know-how. Come on, tell me. For example, in restaurant, why the restaurant gets the revenue? Is it only because of food or because of the servers or because of the environment? A number of factors are there, no? Food means, of course, food available in the roadside also. In restaurant, the revenue is generated not only because of what? So, I've seen some food reviewers. I saw one of the reviewers reviewing the food in Taj Hotel Taj Coromandel. I just order only a juice. It costs us 400 rupees with GST and all. I am not totally satisfied. How they are cheating, I don't know. See, in Star Class Hotel, the juice 400, okay, the 400 you pay, it's not for the juice. But this food reviewer goes there only for the food. It's a royal service you get and feel the ambience and comfort, undisturbed environment. If you go to a cramped local restaurant, here are there lots of other customers will come and grab you and sometimes they may stand behind your table to clear the table because of the crowd. Those things will not happen there. And the treatment, if you demand something, the service may be very worst. So once I went to a hotel and ordered first, it's very hot summer. For the lunch also it's delayed. Rather than reaching 1 o'clock, we reached 2:30, already hungry. And because of summer, sunny days, thirsty. I asked them to deliver the drinking water first. They served this only the half of the eating the lunch. Not totally tensed. But in the case of Star Class Hotel, those small items will not be disturbed. That's a feel. That feel is the intangible. I cannot give that intangible feel alone separately. Okay, it cannot be saleable. In the restaurant, sir, you come, sit, enjoy, go. 500 rupees bill. How can I say so? Come, sit, enjoy, and with small dinner. So the price is not for the dinner. What happens in the case of coffee day? How many of you visited coffee day? Nowadays it's a old coffee day, like an old coffee day, it's totally different. How many of you visited coffee day? Huh? No? Heard about coffee day shops? No. Oh my God. Oh my God. So great history also. Huh? Coffee day. A coffee with 200 rupees sold in the coffee day when they launched the product. In roadside, it's only 10 to 15 rupees. There, it is almost 200 rupees. I saw what that fellow, he charged around 200 rupees. Very costly. Now, also, there is a coffee day in Tilanagar. I just went there once and totally dissatisfied. Because the owner commits suicide also. And the company is supposed to be bankrupt. And his wife took the challenge to re-establish and run successfully. But today, it's not up to the mark. But coffee day concept is pretty different. Have the cup of coffee and you can drink the coffee for 2 hours. They don't ask you to go out. They don't ask you to go out. So what happens? If you want to leisurely spend 2 hours with your friends and go and sit there for 2 hours with a cozy environment, with the air conditioned all, sit there for 2 hours, sip the coffee slowly. If the business people, they want to have the business meet. I too had an emergency meet. I don't find where to go. Immediately I call my other co-partner to come to coffee day. We sat for 1.5 hours for only a coffee. Now tell me, is it coffee 200 rupees or the facility of service 200 rupees? Right? That's the matter. Go and see. Study about the history of coffee. At least in ChatGPT. Search about coffee day and their history. You will get a lot of interesting point. Okay. So that intangible flavor is means bundled with some tangible flavor. You cannot value separately, no problem. If it is not separately valuable, separately non-generatable, yes, of course, it's also intangible assets only. Okay. Maybe non-monetary. Okay. Non-monetary. No physical substance, held for use in the production or supply of goods or services, or even you can rent it out to somebody. It's already told my technical know-how, I allow you to use it and for a fee. All these things are intangible assets. And intangible assets contain the physical substance also. Tally software with compact discs. Come on, tell me, why do you purchase a Tally software and the compact discs? What is the first priority? Tally is the priority. This is only package. The Tally software is packed in the compact disc. So my intention is Tally software. Tally software is the intangible one. Then the asset is intangible asset only. Operating software and computer. Why do you purchase the computer? Are you purchasing for the Windows or computer? Are you purchasing the mobile or Android software? You are purchasing the mobile. Android phone comes. The Android software comes. So my intention is computer, not this one. So first priority goes for the computer. Second priority is only the software. So for operating, this one is used. But I purchased the compact disc only for the Tally. So Tally is the most wanted here. Computer is the most wanted. The Tally is intangible. So the entire this one, Tally and compact disc would be intangible assets. And operating software and computer, my intention is to purchase computer. So this is tangible. So this entire thing, these two will be put together tangible asset. Is that clear? Now. Recognition criteria. Okay. RMPD. Usually, most of the cases, these four will come. Recognition, measurement, presentation and disclosure. Whatever the asset related, how do you know it is an asset? Condition will be given in recognition criteria. What is the value I have to show for that asset? Measurement criteria. How do I account in my books? Presentation criteria. Below the financial report, do I want to give further any information? Yes, that is called disclosure requirement. So RMPD, right? In short, you can remember this way. So it should have the characteristics of an asset, future economic benefit, and the cost reliably measured. And the nature should be intangible. Okay. Just similar to the asset, no? Property, plant, equipment, future economic benefit and the cost is reliably measured, only then it is asset. The same will be applicable here. The asset, in case of property, plant and equipment, you purchase the asset by paying cash or non-monetary also. The same happens here also, acquired and identified. Separately purchased by paying cash, exchange of assets as A is number 10. A is number property, plant, equipment. But if you are purchasing by issuing the shares and securities, fair value which is more evident. Fair value, okay, fair value of the shares or securities or the intangible assets which is more evident. In case of exchange assets, fair value of which is more evident. Exchange of assets. Okay, you get the intangible assets, for that you offer some asset, some of your asset. Okay, then whether intangible asset is more clear or the asset you are giving up more clear. Whichever is more evidence or whichever is more clear will be taken. This is already we studied under A is number 10. In case of government grants, you have to depend on A is number 12. As per the provisions of A is number 12, you have to follow. A is number 12 says, in case of government grants, it should subtract the value of the cost, minus that cost, right? In case of amalgamation, A is number 14 process will be applicable only in case of purchase method. Goodwill is recognized only for the amalgamation. As per A is number 14, the goodwill is recognized, not as per A is number 26. Under 26, goodwill should not be recognized. Now, what happens? The intangible assets you purchase the intangible assets, or it can be self-generated. You can generate your own. Okay. Self-generated or its own. Clear? Now, let me try to finish up this one. Okay. If it is internally generated, goodwill not recognized because not identifiable and not measurable reliably. That's why A is number 26 says you should not recognize goodwill. But A is number 14 allows to calculate the goodwill. Then okay, otherwise it's not so. In case of other intangible assets, for example, technical know-how. How the technical know-how is developed? First you do the research and then you develop. Research and development. During the research phase, whatever the cost you incur that cost will not be capitalized. Once it is confirmed, sir, it is worth, we can now further invest and fine tune it for our usage purpose. In that case, any expenses you incurred, that expenses will be considered as cost of your technical know-how. Okay. Research phase, no recognition, that amount is debited to the P&L account only. Once the research is successful, thereafter for my commercial use, I can still develop it further. Then that time the cost can be capitalized. Like any development phase, expenses incurred, salaries, direct cost, overhead cost, all these things, up to the cost of production, like here up to the product ready, that intangible assets ready, you can debit. But what cannot be debited? Selling expenses, administration, initial operating losses, similar to the PPE, you will come here also. You don't need to study it separately. PPE will help you to understand this concept also. Now, what happens in case of brand, sir? Brand. In case of brands. Okay. Like publishing titles and other similar items. Okay, publishing title. If you want to use my brand for selling your product, give me some money. So then my image, my name has some value, How can I find out the value for my brand? It's self-generated usually. Coca-Cola. I want to use the Coca-Cola brand for my cool drinks. But they demand some fee to pay. Coca-Cola banner is self-generated. They have not spent any money, so it should not be recognized. Is that clear? Provided if it is identifiable. Internally generated and identifiable. Suppose unidentified. The revenue from this particular intangible asset is not recognized or identifiable, not identifiable. Research cost should always be debited to the P&L account. Development cost is capitalized. That will be the value of the intangible assets. Subsequently, if you are doing any more expenses, already developed, now you are using the technical know-how, you are doing lots of business and you are allowing the others to use the technical know-how to generate the money. Now and then you further invest some money to further develop it. If you are investing further, it's nothing but addition of the asset. Okay. So if you are investing further, now the question is that further investment raises the revenue generation or not. If the further investment increases its own level, its own profitability, then capitalize. Subsequent expenses attributed to asset when increases the future economic benefit. No, sir, then this amount can be debited to P&L account. This amount can be debited to P&L account only. Clear? Clear? Next. Next. Let's see. Retirement and disposal. Similar to what? Property, plant and equipment, what you have, you sold it. Sold after the utilization, or you no more it is useful for use. Then the profit or loss, whatever it may be, can be debited directly to the P&L. That's all. That's all. Okay. Now, before we discuss the disclosure concept, that's the last component. I try to finish up some illustrations to make you understand the content what I have discussed up to now. Okay, let's see. Come on, tell me. ABC Limited developed know-how by incurring expenditure 20 lakhs. This is what development cost. Development cost can be capitalized. Okay, was used by the company from 1/4/2011. The useful life of the asset is 10 years. Then 20 lakhs divided by 10 years. You can amortize. Usually in case of assets, you can depreciate. In case of intangible assets, you can amortize. The term being amortization for the intangible assets equivalent to the depreciation in case of property, plant, equipment. Okay, the useful life of the assets from the year of commencement of its use. The company has not amortized the asset till 31/3/2018. Okay. Now what happens? 1/4/11, 31st March 18, they have not amortized. Past journal entry to give the effects to the value of the know-how. Now, how many years are over? Now, we are accounting for which year? 1/4/17 to this year. For this year, how many years are there? 12, 13, 14, 15, 16, 17. 6 years. 6 years, am I right? 12, 13, 14, 15, 16, 17. 6 years over. This is one more year. This is one more year. Okay, one more year. Actually, the 2 lakhs amount considered as a depreciation, like named as amortization by debiting to the P&L account. This will be debited to the P&L account. What about this one, sir? They have forgotten to debit this for 6 years. 12 lakhs, they have forgotten to debit. If it is forgotten to debit, what we can do? This should also be debited to the P&L account, stated separately, prior period item. A is number 4. A is number 4. 5. A is number 5. Okay. C5. Net profit for the period, prior period and changing accounting policies. So you have to link with A is number 5. Now, what is journal entry for this one? On 1/4/11. Okay. Know-how, technical know-how can debit to bank. Development amount you spend is named as bank, value being 20 lakhs. Year on year, you have to debit 1 lakh, if he has 2 lakhs, he has totally forgotten. But in the current year, he has to debit completely. How much he has to cancel the value? Technical know-how value being how much? 14 lakhs. Out of which, debit to the P&L account for the current year 2 lakhs. Another one also be debit to the P&L account 12 lakhs. but this 12 lakhs is named as prior period item. Show it separately. In your current P&L account, you have to debit only 2 lakhs. Another one is error. I missed to debit in the previous year, so I am debiting that. That is called P&L adjustment account item, not your current year's expenses. Current year's expenses. Here, this amortization is named as prior period item. In bracket, you can name this being PPI, prior period items, as per AS number 5. Once you will understand the AS number 5, you will better know this one also, no problem. No need to worry about that. Right. Now, let's move on to the next question. Shift Limited acquired patent rights to manufacture solar rooftop panels at a cost of rupees 600 lakhs. The product life cycle has been estimated to be 5 years, and then the amortization was decided in the ratio of future cash flows, which are estimated as under. Okay. Now, this uh, patent right, we spent 600 rupees for acquiring. Because of this patent right, first year how much I am getting? 300. Second year 400, 300. Third year, so every year 300 for the first 3 years. Thereafter only 150. How can you depreciate? Cost being 600 minus amortization of the year 1. How much? Straight line method we have studied, and SLM method, WDV method, and some of the years digits method. Lots of method we have studied for property, plant, equipment. Similarly here, based on the cash flow we generate, you can depreciate. How much you expect over 5 years period? 1200. For the first year, 300. So from this 600 to the extent of 300 can be depreciated out of 1200. How much? 1/4. 150 will be the depreciation, named as amortization in the very first year. After 3 years, there is a change. For the second year also, what is the depreciation? Based on the income generatable for that second year, overall, out of overall income generated. So 600 into 300 divided by 1200, 150. 300 minus amortization number 3. After 3 years, third year also the same way, 300, right? 600 into 300 divided by 1200, 150 is depreciated. So now the value being 150. After third year, now I mean fourth year, it was estimated that the patents would have an estimated balance life being 3 years. Thereafter, it should have only 2 years, no. But now what happens? They re-estimated in this period. Now the life being 4, 5, 6. Okay. Expected the estimated cash flow after fifth year to be 75. So fourth year 150, fifth year 150, thereafter another 75. Fourth and fifth year 150, but we expected another 75 rupees in the sixth year. Determine the amount of the cost of the patent and each of the amortization value. So amortize in the fourth year. In the fourth year, how much? For the fourth year, 150 into 150 is the balance value into 150 divided by what is the total value of these three? 375. For the remaining period, how much income you expected? In that, how much income is expected in the current year? That ratio will be your depreciation for the fourth year. 60, then 90. Then amortization for the fifth year also 60, 30. And last year amortization being 30, it becomes 0. That's how you can depreciate your asset. You can depreciate your asset. Is that clear? Shall I move on to the next one? The company had spent 45 lakhs for publicity and research expenses on one of its new consumer product. Company had spent 45 lakhs, which was marketed in the accounting year 21-22 but proved to be failure. State how you will deal with the following matters in the accordance in accounts of you limited. See, after research phase, if the research is not successful, all the expenses debited. If it is successful, thereafter development phase is there, no any expenses incurred capitalized. Similarly, in case of advertisement, if the product is failed, we are stopping that, we are supposed to stop the product, then this amount is simply debit to P&L account. It's a loss only, no? How can you consider this being the asset? The entire product and the venture is going to be stopped, so it's going to be debited to the P&L. Because in case of asset, it should give the future economic benefit. It is already closed. Future economic benefit is missing. A company with a turnover of 250 crores and an annual advertising budget of 2 crores had been taken up the marketing of the new product. It was estimated that the company would have turnover 25 crores from the new product. The company had debited to its P&L account the expenditure 2 crores incurred on an extensive special initial advertisement campaign for the new product. Is the procedure adopted by the company correct or not? Usually, advertisement cost is debited to the P&L account only. Okay, because there is no any intangible asset is generated. Usually, advertisement always debited because it will not create any intangible assets. It will not create any intangible assets. Intangible assets means that payment will give me the returns for a n number of future period, or simply I can transfer to somebody else. I developed a technical know-how, but I cannot run the business. Somebody wants that know-how to use for his business, so I can sell him and get the money. I promoted my business widely by spending around 10 lakhs rupees, but I want to stop my business. I asked you, can you take that advertisement cost? Your advertisement cost, what will I do with your advertisement cost? So, predominantly, advertisement cost is debited to the P&L account because it will not create any future emerged any assets here. So, the last theory, disclosure. Disclosure. Okay, disclosure. What do you disclose? The thing what you do, you have to disclose here. The assets, how do you recognize what intangible assets you have and its useful life? How do you amortize? Gross carrying amount, amortization amount, and the closing value. Any addition you have done, like property, plant, equipment, you have to show all the details. That's all. If an intangible asset is amortized over 10 years, state the factors for it. Means maximum amortizable period is only 10 years. If you say that my intangible asset has life 30 years, you have to give proper evidence. Is it really worth for 20 or 30 years? State the factors for it. Any material information regarding carrying amount and remaining capitalization amortization period also be disclosed. Any title restriction, you cannot use it or transfer it, then you have to disclose. Or any other commitment related to the intangible assets. So you got the Tally license from Tally company. You use the Tally software transfer to somebody else also use. You are allowing the others use. But Tally company restricted, you cannot use it for other purpose. Or you cannot sell it to the other purpose. But if I am violating, then it's a violation only. That is called any restrictions or commitment I have to fulfill. All this disclosure should be given below the balance sheet. Hope you will be now able to understand intangible assets case. Now, we'll deal with impairment of assets. Impairment asset is nothing but weakening the value of the assets, where carrying amount is higher than the recoverable amount. In your book, you record the value of the assets being 100, but today the market value is only 80. It's not market value, recoverable value. So the difference between these two is lesser, this is called impairment loss. Actually, first time you have to debit to the P&L account, P&L account. If there is any revaluation reserve already available, then you can adjust that in the revaluation reserve. Okay, that's the calculation is already you learned in PPE, you follow that same. This impairment asset is not applicable for what? A is number 2, inventory, A is number 7, contract, and 13, investments, A is number 22, deferred tax assets. For these, this will not be applicable. Okay. Now, impairment loss for cash generating unit. Okay. See, I have the plant and machinery. Plant and machinery. The cost being, or your book value being 100. Your book value being 100. Okay. Book value being 100. But recoverable value being 80. Then the difference between these two is the impairment loss. Hereafter you have to record at 80 only. But plant and machinery, book value 100, its recoverable value being 80. But the plant and machinery alone will not work. The plant and machinery alone will not work. Okay. This plant and machinery in association with other machinery, men, all these things put together generates the revenue. Okay. If you have the Xerox machine, will it work automatically? Xerox machine along with the shop only it will work. Say, so Xerox machine gives the revenue, shop gives no revenue. Can I sell the shop? If the shop is sold off or vacated, then where do you keep the machine? So then the shop and the machine both put together will be considered as revenue generating unit. That is called cash generating unit. Okay. If the cash generating unit generates good cash, there is no any drop. The cash generated by this entire entity is increasing. This particular plant and machinery's recoverable value is 80, impairment loss is 20, but don't care about that because that plant and machinery alone will not generate the income. It together with some other asset generates the income. The income generated by this entire block is increasing. No need to worry about that. So, no need to worry about that. The asset value will be 100 only. So, impairment loss of cash generating unit. Ignore impairment of division. You have to ignore if there is no impairment of cash generating asset. This cash generating asset is not impaired, then impairment of this asset is ignored. Now, see, you always compare the carrying amount and recoverable amount, right? What is called carrying amount? The carrying amount is nothing but the value appearing in the books. Original value minus depreciation. Then what is called recoverable amount? Recoverable amount is nothing but whichever is higher of these two. One is NRV, net sale value, net realizable value. Net realizable value is nothing but if you sell this as a scrap, you will get 100 rupees, but the commission and the transportation charges you have to pay 5 rupees, so you will get 95. That is called net realizable value. Or instead of selling, if you use the asset, it will generate some income. No. This asset will generate income for 5 years, sir. Oh, 5 years it will generate. Okay. 5 years income generation is summed up after the present value calculation. After the present value. That is called value in use. That is called value in use. Present value of estimated future cash flows and residual value. Everything present value. Okay. So, between these two, whichever is higher will be the recoverable value. So, recoverable value is nothing but whichever is higher of one net realizable value, sale value minus any expenses you spend for selling. Number 2 being present value of cash inflow because of using this. Otherwise named as value in use. Value in use. Is that okay? So, the cash flow includes what? Continuing use of the assets, this cash flow. Projected cash flow also be taken. Net cash flow in the later period, everything taken. But financing activity related cash flow, income tax receipts and payment will not be considered in this cash flow calculations. Is that clear? Now, what happens here? How do you recognize individual assets? The difference between carrying amount and this amount is debited to the P&L account. I can cancel this. Okay. What happens? If you already have the revaluation reserve, debit there. If you don't have the revaluation reserve, debit to P&L account. Debit to P&L account. We have studied there now in property, plant, equipment. The same logic will be applicable. Okay. So this calculation you can skip and you can recollect with the property, plant, equipment related to the revaluation profit and loss. Revaluation profit and loss treatment will be applicable here. Clear? Okay.